to a next. Right? Gaps create price voids, which is what we're after. Right? They look the same as we view intraday charts. These, whether it's gapping inside the bar or it's gapping away from a prior day's bar, it creates a void on the intraday chart. Okay? From that point, we have to put together a plan. And how are we going to trade these gaps? Well, one of the things that we're going to do is we're going to look at the broader markets in the morning when they're gapping. Right? Look at sectors that might be gapping as well. And then comparing that gap, right, as we did in the relative strength section, right, that start gapping with the market or that sector or in the opposite direction. Looking at the broader markets. And just because the market may be opening higher and up from the prior day, that doesn't mean it's going to stay there. Right? Sometimes the markets gap higher and they gap right up into areas of price resistance and they pull back from that. So that's one of the things that we're going to have to consider. The tick. Now, while internals are something that typically take some time to establish, especially the trend, because different stocks, especially on the New York, are opening up at different times. Something might open 30 seconds after the open or a minute or what have you, and that volume begins to build up. The trend isn't going to necessarily give us an accurate picture first thing at the opens, maybe after about 5 minutes or so. Okay? We're going to see where that trend is and which way it starts moving, in what direction. The ticks, on the other hand, they can give us some valuable information, right, first thing in the morning. See if is it opening up in an extreme and which way it starts moving. Right? The stock that's gapping, and we say, is it gapping against or in the direction of the 20 MA, meaning is it moving with the direction of the trend on the 5 minute or against it? And of course, is that stock gapping up into resistance? And so, in other words, we have to take this gap, look at this stock, and whatever the daily chart is telling us, we have to put it in the context of the intraday chart, because that's what we're trading. So we're going to start with that daily chart as a bias. Okay? We'll take note. When we say novice gap, it's something that's gapping up, that's already been up several days in a row, or it's been down several days in a row, and then gapping in the direction of which it's already been moving. Professional gap, on the other hand, is what we're after. And, is it gapping up after having pulled back multiple days in a row? And it may possibly even having a reversal day. Is it gapping up from a climactic buy setup? Is it gapping up after prices may have broken out with a wide range bar out of a base yesterday, which would suggest a continuation. Now, when we get that bias from the daily chart, based on the way it's set up, we have to look at inside those bars and see the structure, in a sense, the structure of the intraday pattern. And because the way the daily chart looks, right, can look the same as another, but the way it formed intraday, right, can be completely different. Okay, so we have to take a look at that. As I said, we're starting with the daily chart for our bias. It's going to be a PBS, it could be a CBS, or it might be a potent reversal. Buy setups obviously assume that prices are going to move higher. Sometimes they gap down. It shouldn't be a significant gap down from that buy setup. If it is a significant gap down, right, well, maybe it suggests we're going to go in the other direction. Right? For example, you have a pristine buy setup, but prices are gapping down to the low or below the low of the changing of the guard. Well, we're going to change our mind, right, about that buy side bias based on the size of that gap. And then we're going to look at how that formed intraday. right, what the intraday chart looks like. That's how we're going to formulate our strategy. It'll be the opposite for sell setups. And then 10-10 bars, what we refer to as 20-20 bars in TPM1. A 10-10 bar just means that the open and closes are really at the extremes. Right? They're more decisive type bars. We look inside of them, see how they formed on an intraday basis, and that's going to dictate our strategy and how we're going to handle that. So we're going to define various setups, and while these can, provide us guidelines, right, the bar-by-bar analysis that we covered, however patterns form on any given day, the bar-by-bar analysis will guide us as to whether we should be entering or not, and help us formulate a strategy. That said, if we had a relatively small gap in prices pull back, right? I've got a daily buy set up and prices pull back into the gap fill, and I get a changing of the guard. It's telling me buyers are taking control. Right? I'm going to be buying it above that bar's high. Right? Of course, this could be a bottoming tail bar. It could be, another red bar with a green bar next to it. And however the pattern forms, that's communicating that buyers are taking control. What this is showing, example 1 here, is that this reversal is happening at the bottom of a red bar on the 5-minute chart. That's okay. Right? Higher time frames that form red bars are multiple bars moving down on a smaller time frame. Right? The transition from red bars into green, right? We have reversals that we take, right? We get long. And if the trade works out, it'll follow through, and then we'll get the red bar. Right? If we're trading from a 5-minute chart, right, same thing, multiple bars moving down, comes into the gap fill, right, where there's support, changing of the guard. And you've got a 30-minute bar that's red. We're getting in on the transition, looking for a multiple bar move to the upside now. Excuse me. There's no way to know that it's going to form and go straight up like that. That would be the ideal. But here we're looking to get in on the pullback to support. Now, however it goes up, right, it'll change on different days. But the idea is that, based on the daily chart, we're getting in at support after a pullback, looking for continuation, right, of the turn, and the daily chart should, dictate that prices are going to continue to move higher. Example number 2, and we're going to take a look at how these intraday charts set up. But with example number 2, with the green bar, right, that's closing above its opening price, this is what we're going to use when we see, that professional type of gap up. With an intraday chart that is an extended, meaning you've got the changing of the guard on the daily, but at the end of the day, prices were moving sideways versus rallying up into the end of the day. So prices aren't extended on an intraday time frame. The first 5-minute bar closes strong, so because it's not extended, we'll buy it above the high of that first 5-minute bar, looking for it to continue to move higher. Okay? Sell setups that aren't extended on the intraday time frame, we can short them under the first 5-minute bar if it closes weak below its opening price. 30-minute highs and lows. Okay? What we don't want to do is buy a 30-minute high that comes after. Let's imagine that example number 1 here is a 30-minute chart for the moment.
Veja bem, o Brasil é país incrível. É difícil para o estrangeiro entender o que ocorre com o Brasil. Se nós tivéssemos uma Sudã funcionando regularmente, financiando regularmente projetos, nós teríamos hoje uma Amazônia brasileira rica, sustentável. Isso ia promover a igualdade, ia promover a distribuição de renda, ia ter um Brasil mais justo.
We don't want to buy 30-minute highs that form like this.
I had my ears pierced when I was a baby.
It's already been running up, right? We should have been getting in down here, right? So a 30-minute high is one in which we would want to buy, right? A breakout from a base, meaning it consolidated prior to the move to that 30-minute high or a 30-minute low, right? We don't buy after greater than 100% retracements in the time frame that we're trading in. If we see this strength, we then either wait for some consolidation, we can wait for a correction bar, right? This could move lower 1 bar and then form a bottoming tail bar, and we could buy that, right? Because there's been a correction. So generally, say we're always buying after a correction of some type, right? Whether it's a pullback, whether it's a sideways consolidation, whether it's a single correction bar. It could be, sure. In a higher time frame, this could be this in a higher time frame. Okay. Okay. We're not trading that time frame. Right? We're trading these type of patterns. Whatever the time frame is that we are trading in, right? Our rules are: I don't buy after a greater than 100% retracement, right? I buy after corrections of some type, right? After that happens, which could be 1 bar. It doesn't have to be some big correction. This kind of strength that clears this high is a tradable void. You got a momentum move higher. It could be a bottoming tail bar where it takes out these lows and rallies back up, and we're buying it looking for a measured type move. Okay? Things aren't always going to set up that way, obviously. And so we have alternate setups. First 5-minute high was green, but maybe that happened after, the end of the day, it was rallying right into the close. So the intraday time frame had already been moving. And so we're not going to be buying above the first 5-minute bars high. And so even though it moved up and then pulled back, right here we've got the correction. I've got a 5-minute PBS. Right, remember, we're starting with a daily setup that's giving us our bias, and so we'll buy it. That 5-minute PBS with the daily PBS. And this point here is to say that it's okay if it takes out the low of the day. And if this comes up and then pulls back greater than 100% retracement, and then you get this reversal, I'm okay with buying that. Daily sell setup. Moves down, retraces back up. It's corrected. Turning point, we short it. Under that bar's low. Daily sell setup. I'm not taking buy setups. And on the 5-minute chart here, it's pulled back. Right? If this has started a move down from a daily sell setup, right, I'm going to be looking for buy setups to fail. Right? That would be the confirmation, right, of the daily, or the green bar being ignored, which is what should happen. So this could be our correction bar, and as an intraday chart, it's not like you're going to get a gap up and a red bar like this, but this could be a topping tail bar, right, which would be ideal, and then we short it looking for a continuation move down. Or daily buy setup, right, would have failed PSS. Right, so it started up, 5-minute bar, starts moving up, begins to pull back, right, probably a bottoming tail bar, right, and then a move above that bar's high to enter on the failed PSS. Here's examples of what we just went over, right? Entries for bullish gap patterns on a daily. Right? And things, again, will set up in different ways on different days. So this gives us our guidelines. Then we'll use our bar-by-bar analysis to tell us exactly what's happening, right, and whether to enter. Right? So over here we've got a 1, 2, 3. For those of you that aren't familiar, we talked about a 1, 2, 3, 4 pattern, which is more, it's a setup that looks like this, where prices trade underneath the inside bar and then come back. Intraday, this is a bottoming tail bar. And then we buy it above this bar's high, looking for a continuation move higher. And so that's another setup to look for. As I said, we're going to look inside of these daily bars. And the example here shows that I've got 2 daily bars, these big red candles. And from the daily time frame, essentially they look the same. They could even look exactly the same. And, the opens and closes were at the extremes. But they could look very different looking at the intraday time frame. Okay? So you see on the one on the left, this went sideways in the morning and then declined right into the close, whereas the one on the right declined in the morning and went sideways throughout the majority of the day. Okay. So this one, honestly, whatever resistance there is, you've got the gap fill, but based on the bars that are there, there's relatively a small amount of resistance. Okay. Whereas the one on the right, we've got all of this consolidation here. So in the TPM1, where it covered these different guerrilla strategies, right? Here, if this was a gap and snap type of pattern that you were focused on, it gapped down and then rallied into the bottom of this bar, well, this is going to be a better setup from an intraday point of view, right, for prices to be able to eventually push higher into this bar, right? Because what's above here, right? As we look at this intraday chart, right? If prices fell rapidly like this, you go, well, what does that mean?
You've had a hard time, but I hope and believe that you found a safe haven in this house, honey. Welcome to our home, Rosebud.
It is a void, exactly, right? You got a price void, whereas the one on the right, you've got all of this consolidation. And so prices, with the example on the right, that prices gap down, rally up into the bottom of this bar, right, is a better odds of forming a sell setup and the daily chart actually resulting in another down bar, right, versus a gap and snap type of pattern where it rallies up into that bar. But the intraday patterns have to be taken into consideration even for your guerrilla strategies as to the odds of those following through. Okay? If you had a gap up and prices gapped up above the high of this consolidation, right, well then that would provide support in theory, right, based on the concept of support and resistance and prices moving up above the top of this base or gapping up to the top of this base. Right? So if I had this red bar, let's say this was moving down several days in a row, right? Let's say for this example that it was in an uptrend, right? Was forming a buy setup, right? We're anticipating a buy setup, and prices gapped up to the top of this consolidation and then went sideways for 30 minutes or 20 minutes, right? It went sideways for 20 minutes, and on that fourth bar, it formed a bottoming tail bar that took out the low of the prior 3 bars and closed on its high. Would you have any doubt as to what you should do next? Right? Looking at the way this is formed. Right? The pattern would be communicating to you, right? The strength in the morning, the move up into this resistance, the fact that it went sideways, right, for 15 to 20 minutes, right, versus going down would tell you that demand was strong at that time. And if it formed a bottoming tail bar that took out the lows, it would tell you that it attempted to break lower, and then demand was strong enough to rally it back up to the high, and now I've got a void up above. You'd be a buyer above that bar's high. Right? Bullish bars, we do the same thing. Right? These bullish bars suggest prices are going to continue to move higher. The one on the left was rallying into the end of the day. Right? So on the intraday time frame, we say, well, this has already made a move. It's a bit extended. It probably needs a rest. Right? Whereas the one on the right, same daily bar, right, was consolidating at the end of the day. We get a gap up from this bar. We're okay buying that above the first 5-minute bar's high. Right? It was resting all afternoon. It showed its strength by not dropping after rallying strongly all morning. Buyers continue to step up. It moves above the base. Right? Well, sometimes maybe it gaps up and the first 5-minute bar is red and it pulls back and then forms a bottoming tail, or it forms a changing of the guard. Right? We get a buy setup. Well, I prefer this price structure intraday than the one on the left. Okay? Whereas the one on the left, if I had to write the scenario, I'd like a 30-minute high. And if this went sideways or chopped around, it was able to show that the strength, the ability to hold up after this move higher, right? Well, that would be a good setup, looking for prices to move up. Right? The guerrilla trading patterns, well, this is going to be a better gap and crap, right? Because it's extended on the intraday time frame. It's been running up, right? Whereas this one here showed strength, right? It gaps up and comes back into this consolidation, right? Buyers are going to step up again. On the other hand, if it gaps down under, you get a gap down from this kind of a bar, and it gaps under here. Think about all of those traders that bought this into the end of the day expecting higher prices, and it gaps down. Now they're all holding losses, thinking about, what am I going to do with this? I was thinking it was going to move higher. Now I'm underwater. There's a void below. Well, that could set up the next move down. Whether it's a 10-10 bar, or some type of reversal bar, or it's a bottoming tail bar, we still have to look at how it formed intraday, right, to give us our bias and strategy. Although bottoming tail bars tell us that buyers stepped up, right, looking at the daily chart, I want to see what it did, right, at the end of the day. Was it running higher into the end of the day, whereas on the intraday time frame, right, it's up multiple bars in a row, rather than having consolidated, right, into the end of the day, right, and having moved up in the earlier part of the day.
What, dear?
Your hearing aid is on the blink, huh?
What?
Your hearing aid.
Topping tails, right, you got the idea. Right? Was it dropping into the close? Right? Was it consolidating? Right? Let's say we have a climactic sell setup. Right? I got a nice topping tail on the daily, and I'm looking to short that. Right? Went sideways all afternoon. First 5-minute bar closes below its open. It's okay. I'm fine shorting that under that bar's low. Right? Whereas with this one, let's say it gaps down, I have a 5-minute bar closing below its open. Right? I'm going to wait for a retracement. I'll wait to see if it can go sideways for a little while. If it keeps dropping, I'm not going to chase it. Right? So if we were to get rid of this daily bar, and we didn't even know it existed, and we just looked at the intraday time frame, we would not be shorting, right, after like 7, 8, 9 down bars. We're going to wait for a retracement or a consolidation or some type of a correction before we're going to enter. Right?
History, dear. American history.
Is that the story of this country? Just like the story of a person?
Exactly.
On all of these next slides,
Let's have a wonderful bride.
we have this blue box here, and what that is showing is the two current daily bars. Right? The red slash here is the open of the new day, right? The red box here. The prior candle here, this candle is showing this is showing what happened inside of that bar at the end of the day. Right? We're not viewing anything that happened on the first daily candle. I'm not viewing on this intraday data. I'm not viewing what happened at the beginning of the day, right? But I'm viewing at what happened at the end of the day. Right? And then on the right side of the slide here, this data is what happened, right, after the open on the current day. Right? I hope everybody's got that, because there's usually there's a question as to, or some confusion as to that. So, and we've got two daily bars. Right? This data, the beginning intraday data, is what happened at the end of the day. Right? Here's the open, and then it's what happened on the next day. Right? So this one here, I've got my daily chart that suggests that prices are going to move higher. I've got a bottoming tail bar, right, which is a correction bar by definition. Right? And then the next day, prices had gapped lower and then rallied from there. At the end of the day, prices were consolidating. Right? Look at the moving averages here. Right? I've got a flat 20. The 200 was declining. So you can imagine what was going on the daily chart. Right? This was correcting for several days. That's why the 200 is sloped to the downside. Right? So I've got a long bias based on the daily chart. As prices pull back into support, right, we're coming into the second reversal period here. Here's a wide range bar up. So now I'm looking for what's happening, right, bar by bar. Right? Where's the entry point? What bar gives us our signal in this example? There's actually two, but the first one doesn't trigger.
No, yeah, I just felt my veins.
I have to present the first issue of my magazine at the Garden Club meeting tonight.
Well, I drive you, darling. You got no business behind the wheel of an automobile.
Small red bar.
And why not?
Well, if you're thinking of the wrong thing, you're liable to run into a conflict.
Right? We either could have bought it above the high of this bar right here, right? But this one here, right, that bottoming tail bar, right, that is ideal. Right? That is a great entry because it took out that bar's low. Right? So it attempted to move lower. Yeah, it's like a shakeout. Right? It attempted to move lower. We know that was a red engulfing bar, right, before it became a bottoming tail bar. So that helps remove supply. It rallies back up, so we place a buy above that bar's high. Right? And then, right, as it begins to move up, right, remember, we have a thought process here. That's what we've been, building with all of these different concepts. So our thoughts, right, knowing that this corrected over here and I've got a pivot high, I'm going to be thinking that there's going to be some sellers here, right? But the other part of our rules say that where's support? As this starts to move up, right, what is my first reference point of support?
I'll be damned.
And inside the box is resistance. Right? That's resistance. Right? Right. A prior bar's low. Right? The bottom of the preceding bar. Exactly. Right? So as this is moving up, I'm anticipating that some sellers are going to show up over here. I don't know what's going to happen. Right? There's no way to know. Right? So what we need, management rules. So as this begins to move up, all you can do is monitor at that point. You can look at, what the broader markets are doing. Are they rallying? You can look at the ticks to see if they're accelerating to the upside. You can just watch how this is moving, right? You could be looking at it even on a smaller time frame to see if the momentum slows down, right? In this case, probably it did not, because the size of this bar just kept pushing up. The daily chart, topping tail, tells me sellers came in on that day. Next day closed strong, right? Started to move up, but this topping tail gives me a reference point of where sellers were before. Prices gapped significantly into that bar's range. We look at how it formed. Intraday, it was moving sideways throughout the whole afternoon, and it even pushed higher, right, into the close, which says that buyers believed that this was going to go higher, right? And they stepped up their buys into the close in anticipation of a move higher in the morning. So when it gaps down, it's gapping down from a consolidation. Topping tail. It's close to the supply here. Right? This is okay to be shorting under the first 5-minute bar's low. Right? It's close to the supply, overhead supply. You've got a correction bar, came up and tested that area, got knocked back down again. Right? You've got a void below. Right? Sell it short, see where it goes.
You said yesterday you loved Mrs. Haley. Now, is this any way to repair? Don't you know she would fly to you defensive if anyone tried to hurt you?
Next example. I've got bottoming tails. You have a feel for shorting.
Don't cry. Here.
I'd say that's a personal choice, Footer. Whether you use a 5-minute low or a 2-minute low. If the 2-minute low, if you're saying the 2-minute low was a red bar, again, look at how things formed based on what we're talking about here as a guide. Are they the 2-minute low? You're saying that, so after the first 2-minute bars forms, they're entering position? They might be looking at, I'm not sure, but they might be combining a pre-market chart with that. Maybe, they're looking at a tick chart from the pre-market. Let's see what second bar does. Yeah, it's okay. I mean, if you got your bias from the gap, and you're looking at how it formed intraday like we're talking about, that's fine. A lot of the move lately has been happening in the early part of the day, and then the rest of the day is a lot of times is a non-event lately. Daily chart, right? Buyers are stepping up. Consolidation inside that daily bar. So we say prices are not extended. Right? You get a gap up. So now we start thinking, right? Possible gap fill. Right? Maybe it pulls back. And I'm thinking that because of the red bar. It closed below its open. So here you get a reversal. It turns back up again. That shows that demand picked up. It's red, green. Right? It's holding up. It's forming a base. So we'd be willing to buy that above that bar's high, looking for it to move higher. We've got our daily bias. We've got our consolidation into the close. Right? We've got an intraday chart that isn't extended. I've got a pattern here. Right? Bar by bar says demand picks up, void up above. In this next slide, we've got this big 2020 bar. Right? Prices have been moving up. And so from looking at the daily chart, right, we wouldn't be looking to enter a daily chart after it's up a couple of days. But that doesn't mean we can't trade it intraday. So we do the same thing. It's a big bar. The range expanded, but it consolidated throughout the afternoon. Okay. Here's the gap up. Okay. It pulls back into the gap fill. Okay. This isn't the type of pattern that we look to buy above this bar's high just because of the way it came down. Okay. But after it moves back up again, right, reversing this red bar, then we get the consolidation up at the high of the day. And that's why it's marked as an ideal 30-minute type of high, because that consolidation, and we know that there's sellers up here, and it consolidates prior to the move up. So it's taking in that supply, right? We're buying the breakout, and then manage it accordingly. Now, this example, right, this is one in which the alternate entry, we'd be looking for that because it was rallying up into the end of the day. And so there's a void up above. Right? So this one could whipsaw us, right, as it moves down like that. I mean, in this one, it did move down in this example, but there is the possibility that this could take out the low and then move back up and form a PSS. Whereas as it moved down, right, we see that it cannot rally. We see topping tails. So we have an alternate type of entry here, right, looking for the move lower. Right. Red MA is the 200. Right, we went over yesterday with the moving averages. Right. You see that moving average there. Look over to the left. See if there's anything in alignment with it. Let's say market internals here. Right. What might you look for here based on market internals? Let's say you were monitoring the ticks. And based on what we discussed this morning. Let's say on this move down, what would you look for? Right, tick confirmation. And what might have happened here that would have given you some guidance? All right, negative. We saw that the ticks, right, as this moved down, the ticks moved down to say 7, 8, 900. Right, there was some decisive or strong selling on the move down, and then when the ticks retraced off of that low, let's say the ticks moved from an 8 or 9, negative 8 or 900 up toward a plus 100 or so. And this stock did nothing. It went sideways. So it showed relative weakness at that time. The tick is giving me some guidance as to where the market should reverse back to the downside. Right? And I'm timing my entry, right, with that tick retracement and the concept of relative weakness. But here is a good setup. Right? Here's a gap in crap. And up several days in a row. If you like the guerrilla strategies, right, it's up several days. You look inside the last green bar, and it was rallying, right, into the close, and then it gaps up, which we would view as a novice gap. Right? So the breakout failure here would be an entry for the intraday trader. Right? This is where someone using the guerrilla strategies would be entering. Now, with a pattern like this, right, I really wouldn't be thinking that this would hold up. Right? And the gap fill is support, but based on the rally, right, if I saw this happen, I would be thinking that it would drop down through it. But it did hold up. Right? And it eventually failed. Right? But it held up pretty well, considering the type of setup. Right? Potent changing of the guard. Right? What is that in a higher time frame? Topping tail. Right? So when I see a green bar pop up like this, and it's followed by a red bar that moves back down to the low of the green bar, I know it's a topping tail in a higher time frame. It's a bearish pattern. That's why we look to these type of patterns, right, for short entry points. Right? Cluster of opens and closes, that little consolidation there, that's your minor support. Now to move down like this, it's a stall point. I'm going to look to the left to see what's there that might be a stall point. What is that topping tail bar based on what we covered before lunch? Okay, what level pivot is it? Right, it's a little continuation type pattern. Right, we said we used that concept, right, that topping tail bar after an initial move, an initial strong move. Right, we use it as an entry, level 1 pivot. We're looking for a continuation of that initial move. So here's our daily chart. Momentum is slowing down. Okay? Prices were declining into the close. Gap up. Right? We say loose supply we've defined as pivot highs and lows. Right? It's a weaker reference point of overhead supply. Right? First 5-minute bar closes at its high. Right? We can buy it above the high, put a stop below the low. Right? Comes up into resistance. 200 MA is there. Right? We're going to look to take profits up in that area. Daily reversal 10-10 bar. Look inside of it. Consolidation. Right? So in this example, we got a small gap down, but the gap fill is right here. Right? So with that in mind, I know that this is resistance. Right? Here we have an alternate entry. Our bias, right, is to be a buyer here based on the daily. Right? Prices pull back. Reversal period at 10 o'clock. Doji bar tells me that momentum is slowed down. Green bar reversal. Right? Buy it above the high. See what'll happen. Right? And the little tail bar here, little inside bar, momentum is slowing down. Our first reference point of support is a prior bar's low. Right? Prices pick up again. Momentum picks up. Notice this bar here. Right? It closed right at its high. Right? So after prices were moving up 1, 2, 3, 4, 5, 6, 7, 8 bars, and prices are moving up 8 bars, and now demand is strong right into the end of that bar. What else about this bar? Besides the fact that it closed on its high, tell me something about that bar relative to the bar that preceded it. Demand was strong right into the end of that time period. Exactly. It's narrower. The range contracted. Right? So, and inside red bar, next bar's got a little tail, momentum is slowing down, odds are you're going to get a retracement. Okay? Doesn't mean you short it, right? But you're looking at this and saying, oh, it's probably a good time to take your money. Different pattern than what we've been looking at here. And prices are pulled back on the daily, momentum is slowing down. Got to gap up. Right? Well, where's it gapping up to? How does it react to what's to the left there? And so it's gapped up into this congestion. And I've got a void above. Remember, the daily is giving us our bias, so we're making the assumption that this has been pulled back to support. Right? Bottoming tail bar. Right? This is one of the most consistently reliable type of patterns that you can find. A bottoming tail bar taking out lows with a long bias to buy it above that bar's high. Right? Well, that bottoming tail bar was a correction bar, was a big red bar, rallied back up, you buy it above the high of the bar. Right? 200 MA is a reference point. Look over to the left, see what's there. Right? Anyway, you're trailing prior bars lows. And so these gap strategies, that's what we look for in the morning. We look to get paid off. You know, typically, as it says, 15, 30 minutes or so. You know, in that amount of time, you're either got your money or there's enough information that you better reconsider the trade. Right? And the tools that we've been talking about are what's going to guide you. Right? The bar by bar on the internals. So the tail. The risk to reward. Well, I don't even have prices on here, so we don't even know. You know, the price ranges here, and you know, when you say risk to reward, my assumption is it's taken out the high of the day. Right? I'm not the high of the day here. You know, based on the daily, is that this is going to take it out. 1-to-1? I don't think so. I mean, to say that this bar here, if you're entering above the high of that bottoming tail, and your risk is below the low of that bottoming tail, I mean, this is more like, you know, 3-to-4 or 4-to-1. Right? I mean, you know, your enter is here. No, you never know what's going to happen next. You know, we know that. No, my target isn't the high of the day. Remember, the daily chart, the daily pattern, right, is one in which suggests higher prices. You know, my target isn't the high of the day. Right? It's like with, you know, in an uptrend, my assumption is it's going to take it out. And so this doesn't have to have, you know, pulled all the way back to where this bar here is your target. again, the daily chart, that is going to be a reference point of resistance. Right? We don't know what the reaction is going to be to it. Right? But based on, you know, the daily chart, the gap up, the correction here, right? I'm looking for it to go higher. And I don't know that it's going to get to the 200 MA, right? I don't know that it's going to get through here or it's going to stop there. But it's a good, the setup has good odds of getting through it. Okay. All right. Now let's move on. Running tails again by stuff. Exactly right. Right. You know, that bottoming tail bar, as we covered earlier, it removes supply. It's a type of failure pattern, right? In that it attempted to move down and it didn't, right? And those failure patterns, you know, they create, you know, the type of demand that can overcome supply. And we have to make certain assumptions, which we do, to place any trade. And in that section, you know, we combined the daily chart, we combined the structure of the intraday chart, and from the inside that bar, we looked at the patterns that formed on that day. And when we talk about pattern failures, and as we talked about earlier, the bars, patterns, are pictures of what other people are thinking. They tell us what their expectations are. And when those bars or complete patterns actually fail, right, traders start to trade in the other direction. Either to exit positions to not lose money, right? Or traders that identify those patterns and take advantage of them, which is what we want to do. Sometimes patterns just don't work out and we kill them, right? We have stop losses, so we step aside. Other times we recognize patterns that are setting up, right? Whereas there's an attempt to move against the larger bias, and that's for the most part. When I talk about failed patterns, that's primarily what I'm looking for. I'm looking for an attempt to move against the bigger bias there. So bar failures or pattern failures set up new entry points. No problem. There's reasons why patterns fail. Right? Sometimes it's just the time of the day where volume is light, in the doldrums. Right? Patterns that set up, that suggest buyers, not suggest, they actually do communicate or show us that buyers stepped up in the moment, but it happens against the longer trend or the larger trend. So they fail. Breakouts with no tradable void, or breakdowns with no void. Market internals have reached an extreme already, whereas the pattern was showing relative weakness to the internals, and then it triggers an entry. Patterns form after big retracements. Another way of saying, the larger time frame is against the smaller. If you get into a pattern that doesn't work out, well, first thing to do, is recognize what's happening. Right? When you say act unemotionally, And the first thing to do is to recognize that you're getting emotional, right? You're getting tense, right? So you recognize that, you take a breath, reevaluate what's happening, right? Of course, you had a stop loss before you got into the trade. So if you didn't take your stop, you're going to need to reevaluate, decide what you're going to do, right? And how you're going to get out of that trade. Sometimes we get into trades and our stops aren't hit, our targets aren't hit, things just aren't moving. Right? So we've got a time-based rule that essentially says, be objective and look at what's happening here. Right? Let's not rationalize, because we got our money on the line. Right? The rule doesn't say that we have to exit the trade or really do anything. But it does say that if things aren't moving the way we had thought, typically the patterns that we enter on, they typically result in a move immediately, right? Or initially in our direction. And if that doesn't happen, we may have missed something. So, and the 3-bar rule says to reconsider, look at the bars that formed, right, and evaluate the situation. So as I look at patterns, again, they're telling me what other people are thinking, what they're doing. Right? If I'm in a trade, right, I've participated in the formation of that pattern. Right? So I've helped form that picture. Right? If it doesn't work out, right, we exit the trade. Right? Period. Right? We minimize loss. If we recognize patterns, right, that again, bars that form against the prevailing trend, provide setups. Right? Well, somebody was trading against the trend. Right? Trade didn't work. Right? That can help me recognize when others, are on the wrong side of the trade, right? To make money from that. Right? So the things that we'll consider, right? Everything we've been talking about up until now, right? Retracements, right? Maybe a sell setup formed, but it happened after prices retraced like 80-90% of the prior decline, which was displaying strength. Right? Prices, are at support or at resistance, and so buy setup forming at an area of resistance. And so everything that we've been talking about has to come together, right, in our analysis to determine the highest probability trades. Right? Is there a tradable void? Right? Although you get a setup, doesn't necessarily mean that there isn't, right, resistance right to the left of it. At times, patterns just aren't going to work out. Okay? So, as it says, know when you're wrong to minimize your losses. Prices were in an uptrend. They pulled back, rising 20 MA, right? Changing of the guard. Right? Why didn't it trigger right away after that changing of the guard? Right? Then you get a bottoming tail bar, right? Clears the lows, right? You see this pattern, right? Tomorrow, Greg must have mentioned those bottoming tail bars about 100 times. There it is, right? You click the mouse and you're in. Right? First bar forms with a topping tail bar. Well, that wasn't on the slides, right, with all the ones that worked. Right? So in the bar-by-bar analysis, you're questioning the trade there. Right? It takes out the low of that topping tail bar. You should have your hand on the mouse, ready to exit the trade. Right? Something on this setup here that may have made it questionable. Right? Look at the high. Right? Look at what formed there and how it pulled back. Well, topping tail isn't ideal, that's for sure. Right? But look at the bar after the topping tail bar. What did it do? and it gapped up and it failed. Right? It gapped up and then it fell and engulfed that bar. It's a wide range bar starting to move down. Right? So that buy setup was preceded with a bearish pattern at the high. That's the most conservative thing to do, footer. It really should not form as a topping tail bar, and the main focus is to protect capital. So it's okay to do that. And if it turns around and goes in the other direction, that happens. All right. So you played it kind of tight because something happened that you didn't expect to happen. It shouldn't have happened. So it's fine to do it. And if it turns around and it goes, just accept it that, it's going to happen sometimes. And this slide shows a setup that at this point in the class, I'm sure none of you would take. Right? But it's an example, or to reinforce the fact that PBSs, or what will meet the definition of a PBS, can be a low quality pattern. It formed after a rounding top, and prices had run up, attempted to go higher. You had a big green bar here that didn't follow through and it pulled back. But if you were scanning for PBSs or you had ESP scanning, this would come across, as a buy. So we have to look at the patterns and, question, is it a quality pattern? And this upside shakeout here, this move up and this move back down, was bearish, but it didn't follow through. And so that failed to follow through. This was consolidating at the bottom of this bearish wide range bar, and it started inching its way higher. So it was trending up. So although the initial move up failed, it failed to follow to the downside as well. So we had a failure of a failure, and as it says, bar by bar keeps you objective. There's another example of prices having moved up, and then right near the high, you get a bar that closes at the high of the range, and that preceded the slowing in momentum. Look at the way this went up. There was constant selling on the way up. As this went up, traders kept anticipating that this was going to pull back. That's what these bars are telling us. Every time it pushes higher, it gets knocked back down, but it doesn't break a prior bar's low. So here, and that's what started the slowing in momentum and reversal. And so this buy setup, this PBS, was of very poor quality. It's not something that we would take. Here's another PBS. Really nothing wrong with the high on this one. A little bit extended, but hey, prices pull back, and who's to say they can't get even more extended after a pullback? It came into support here, these overlapping bars, this area of minor support at a narrow range. What about the angle this pulled back at? Pretty much came straight down. The angle this retraced at certainly wasn't ideal. Now, assuming that you entered rising 20 MA support, so on, and 3 bars later, reconsider what's going on there. Sharp move up, 2 wide range bars breaking out out of a consolidation. Right? And prices continue to move up. Now, odds are it's going to continue to move up. Right? But here's a big red bar, right, which gets traders thinking that prices are going to go lower. Right? As I said, failed expectations of the prior candle. Right? You had a gap up. And it gaps well up into that bar's range. Right? Don't just think that this was a daily chart, and I think it was. This was a daily chart. Right? This could be on your gap list in the morning, and you would then go through what we spoke about in the prior section. Right? Our bias is long because the trend is up, prices have pulled back, right? Got a significant gap up. You look inside of this red bar, right? It was basing at the end of the day. It's gapped up above the base. You look for an intraday pattern. If we weren't in, would we still get in now? All right, you move your stop, or you might just get out. Right? The idea here is, right, to look at it objectively, right? Like you said, as if you weren't in it, right? And reevaluate what's happened. And bearish bars against the trend, right, often do not follow through. Right? They're just pullbacks, especially even a big bar like this, while it's showing momentum to the downside. Right? It's a bunch of little bars in a smaller time frame, and it's pulled back to this support here. Now, this bar, right, it does create, it says bearish expectations. It creates uncertainty. And so several bars later, right, more information becomes available. And so red bar didn't follow through. I see that here, and it's inching up. The trend is up. Right? So we say demand is building over time. Right? Demand is continuing to build over time. We're looking for prices to continue to move higher. And note here about wide range bars and uptrends. That sharp move down, or that big difference between these prior bars close and this one, right, rolls oscillators over. Right, traders looking at oscillators, right, that creates a bias that prices are going to move lower. They start shorting. You see that it's not going down. And trend is up. Here's a breakout. You know what this is. What is this in a higher time frame? Right. We know what that pattern communicates. Those two bars. All right, those 100% retracements of a prior candle. Right, or sometimes I call them like a 180. Yeah, right. Well, and this is like a shakeout as well, because it's taken out these lows and it reverses back up again. Right, it's a correction. Right, so depending on the time frame we're looking at, it could look like this, or it could look like a bottoming tail bar. Thing is, we need to be able to recognize different time frames, different days, different market environments form different patterns. But although the pattern looks different, it can have exactly the same message. Like this slide is what we're going to be looking at next. It just gives you the text to explain the patterns. We've already looked at several shakeouts. The other setup is a breakout bar failure. It's more of a warning pattern that says take profits, because they shouldn't form. All right? And we'll look at examples of that. All right. Downside shakeout. Prices had been moving down. That creates a void. Right? The consolidation tells us that sellers keep stepping up. Right? So after a period of time of traders buying and they can't advance prices to the upside, prices drop. Right? And then for whatever reason, right, they immediately reverse back up again. Right? When that happens, right, shorts start to cover. Right? Those that were thinking about buying it, right, they start getting more confident. When it comes up into this area here, I know that there's going to be sellers. As I said, we don't know what the reaction is going to be. But if it can move sideways, right, up at this resistance, it tells us that demand is strong. And the way that we recognize that is red bars that don't follow through. Attempts to drop or move prices lower fail to follow through, reversing back up again. Right? Here's one of our candles closing at its high. It didn't move above the high right away. It consolidated, and then it began to move. Right? Here's a strong move up. Right? This continuation setup here, the only thing missing is the fact that this bar didn't take out the low of that bar. Right? So, while that is something that we want to see, right, sometimes it's not going to happen. But if this bar took out that low by a penny, that would be what we want. But again, a little common sense here is that it is correcting and it's strong and there's a void. Yeah, sure. Downside failures or downside shakeouts like that are definitely going to be more common, all right, in a strong market environment. Absolutely. Upside shakeout. Prices had gapped lower. Right? They consolidated here, right? Building up an area of support. Right? Here was the attempt to move up into this void, which failed, and prices came right back down. And now they began to consolidate in this area here, and going sideways, building up some supply. Right? So this tells us that traders got caught long. Patterns are a reflection of what others have done, what they've experienced, in other words, right? And in turn, are their expectations, negated, right? What are they going to do next? Right? Put yourself in the pattern. Right? You are a buyer here, and this is pulling back and going sideways. You're thinking about selling. Right? Then what's going to trigger it? A bar like this, right? That was higher. It was up at its high, taking out the high of these most recent bars, and it gets knocked back down again. It tells you that there are traders offering out above these recent highs. Right? Why would they be offering out above these most recent highs? Based on what we've been discussing, right? As prior reference points that give us guidance as to where others have sold before. Within that base, what do we see? Exactly right. There's a topping tail. All right. Let's move our little arrow over here. Right. That topping tail is a pivot high. So pivot highs tell me where new reference points have been created. Exactly. Same thing as you learned in TPM 177. right? If you have a stock, a stock that's consolidating that was weak, right? And you're shorting below a bar's low, you're not waiting for the low of the day. Right? And one of the reasons we're focused on these kind of bars that take out these highs and come back in again is because they correct. Right? They correct, and when they take out the low, odds are they're going to keep going down. So here's a breakout bar failure. There was a strong move up. You get a little consolidation, and then prices break above the high of these bars. Right? We're looking for relatively equal highs, and then a continuation. Got a little topping tail bar, and then the inside bar. Right? So when it breaks the low of that inside bar, you want to start paying attention. Because if you're long here and you've got this kind of a pattern, especially after this bar formed, right, this little green bar here, that's supposed to be going higher from there. Right? So this pattern tells you, think about taking your money. Right? But once it's got to break the low of the inside bar. If it breaks the low of the breakout bar, right, the pattern is confirmed, right, and it says it should continue to go lower. Now, this wide range bar is igniting a move down. Right? You got the continuation pattern here. This support here, you got this little bit of support here and this little bit of support here. And as we covered in the support and resistance section, we don't look at this whole consolidation as being support. Right? Prices traded underneath it. Right? And then they traded up through it and continued higher. So the only thing that I'm focused on here, right, in reality, it would be like this is the chart. Right? That's the chart. Right? Everything over there to the left of that is irrelevant. Right? So can it stop at this area right here? No, probably not with a breakout bar failure and a wide range bar igniting. Right? Failure patterns like this create a lot of supply. When longs get caught, right, and prices are going down, they don't look at support and hold on and say, well, I'm going to hold on because there's this little shelf of support there and things are going to hold. I mean, that's what novices do when they get caught, right, in a trade. They look at areas and they say, well, I think I'll be okay. Right? This little breakout here, that is how you want to play breakouts out of a base. Right? They consolidate before going higher. Right? Let me get rid of this box here. Right? This little consolidation there. Prices moved up and they began to absorb the supply over here. Right? You got this correction, taking out the lows, and it came back up again. Right? So again, sellers were coming in and buyers were absorbing that supply, and that's what these bars are telling me. Red bar ignored, takes out the low, comes back up again, should go higher. Right? So now, say we're long, prices are going up. We have to be objective about what's happening. Right? As they continue to move higher, right, we get this tail bar here. That's got to be something that we look at objectively and say, sellers came in here, inside bar. Right? Well, if it takes out the high of this bar, right, those thoughts about the sellers coming in, they go away. Right? On the other hand, if it starts breaking lower, right, we know what's happening there. Okay? breakout bar failure, and this one's to the downside, right? Where prices consolidated at the bottom of that bearish bar. Right? Here's a topping tail, right? Taking out that high, right? And now it starts to break lower. Right? So with this pattern, say we're thinking prices are going to go down. Right? We look at this; it broke down. Let's even say there was a tradable void, potentially below. We short it below that topping tail bar's low there, and after this bar is complete, I'm staring at this bar with this tail on the bottom. Right? That's not what's supposed to happen. Right? Then I get an inside bar. Right? It's taking out the high of the inside bar and it starts moving up. Right? Trade's not working. Marked there, it's 10:30 reversal period. And now this made a new low. It retraces back up again, and it takes out this high. Right? Looking to buy pullbacks. Right? So after a lower low and a retracement up above the prior high, our rules say that we can buy a pullback. Right? There's a potent reversal. You can buy it above the high. 200 MA, there's nothing to the left there. Right? Once it comes up into this area here, you have to be thinking about being a seller. Right? Because that's where others are going to be selling. Right? This might be a breakout failure here because of the tail and the inside bar, but it hadn't broken yet. And bearish bars ignored tell me that buyers are in control. Right? And this happened after a strong move higher. Right? Another big red bar. It's a significant gap up. Right? Bar is closing at its high. Again, red bars are corrections, but do they follow through? Right? Are they immediately reversed? Right? The price is gapping up from them. Bar closed at its high, prices are pushing higher. Right? We're still looking for higher prices. Right? This was a resting period, and then there was a topping tail, right? An inside bar. Right? Now, this is, well, it's not exactly the same, but the idea is similar to what we see in the market right now. And if we were to look at the NASDAQ or the Qs, there was a resting period. Prices cleared the high of the resting period, and it ended with a topping tail bar. And Friday, prices began to move down from there. Right? If you look at the Dow, right? If we were to look at a chart of the Dow, we might have exactly, what we're covering here right now. Let's bring up the chart. And that could be in this section. All right, we'll see if this breaks below that inside bar's low tomorrow. Right? And ultimately, does it break below the low of Thursday's low? Then we're going to have a confirmed breakout failure. And daily chart. Right? Shock because it gapped under. Right? The little inside bar. You know what's interesting here? Well, the Qs, you don't have the inside bar, but that's okay. So it took out the low of the topping tail bar. So it's definitely a more bearish pattern. But what's interesting is that the futures didn't take out the low. You don't see that happen too often. Maybe it did by a couple of ticks. and it did by a couple of ticks. Those are the NASDAQ futures. Again, we had a resting period. That was preceded by bottoming tail bars. It broke out above the highs. It's not supposed to close with a topping tail like that. And Friday was just lower volume. Now we'll see what kind of follow through we're going to get tomorrow morning. Our next slide here. I say no one others are wrong to profit. Prices had been trending up. 200 MA is a subjective reference point. That said, you have a lot of people that think about selling at a 200 period moving average. Big red bar, right, engulfing these prices and create bearish expectations for lower prices. There was no follow through, right, to that. Right? Prices reversed. They continued to inch up. This bar right here, right, says prices are going higher. Right? It took out that bar's low. You got a little tail on the bottom. It closed on its high. It's retraced. If you look at retracements of this bar here, it's about 80% or plus. Right? It's not going down. It's not going lower. Right? Tells you demand is strong and buying keeps picking up here. Right? Odds are it's going to continue to push higher. Measured moves are moves that occur where prices ignite a move, and we look for these to start either from wide range bars or a base, and they set up either at a subjective reference point. In this case, I'm using a 50 period moving average, but this could be a fib retracement level. In fact, yeah, it's starting with a big bar, igniting a move down, or it can start a move up from a consolidation. One begins the reversal at a subjective reference point. The other one begins its reversal from an area of price resistance, but it's accompanied with a deep retracement. In this case, it's moved up, right, and retraced, right, this whole decline, and when it reaches this area, right, sellers come in because that's just what they do. When prices retrace to an area of resistance, there are going to be traders offering out there, look, in anticipation that there was sellers there before, right? There's sellers there again, but the retracement signals strength, right? And the failure to move lower sets up a measured move higher, right? Over here, buyers step up, right? But this was igniting a move down. Buyers step up at the 50 MA, look for a failure, and it sets up a measured move lower. This text slide explains what I just went through, and again, we're either looking from a wide range bar or a base, right, setting up at either a subjective reference point or a deep retracement to an actual reference point, right, meaning price. Now, we looked at this slide earlier, and in the trend section. This was a deep retracement up into resistance, right? It's showing strength. Right? You get a correction, and then you look for a continuation pattern. Right? And I said this yesterday, right? Continuation patterns, the highest odds continuation patterns occur after the first or initial move up, or the start of a move. That's the highest probability of a continuation pattern following through, and they usually result in a measured move, right, when they set up. I have no idea, Sanjay, You know, I've seen it for many, many years. I don't know. Some would say, you know, this is an initial thrust, you know, and then it happens again. You know, I don't know. I don't have an explanation for it, but I've seen it, you know, hundreds, if not thousands of times. And usually what happens is that when this sets up, this move will continue until it reaches the next reference point. A wide range bar, igniting a move up, right? Note the bottoming tail bar. Right? We don't short sell setups, right, that begin from wide range bars. Right? Historically, they don't work out. Right? I found that out by losing money, right, by doing them and just looking at a whole bunch of trades, right, and finding out that, hey, a lot of these begin with bullish wide range bars, and they don't follow through even though they're under their 20 MA. And we have that measured move, right, comes up into resistance, and this is a bullish consolidation here. Right, this is consolidating, you know, the angle that they consolidated at, right, and then you get, you know, a nice bottoming tail bar there that closes on its high, takes out that lows. That's your signal bar, right, that says it's going to move higher from there. And as it's moving higher, you know, you're still objective in monitoring what's happening. And so there was a little rest. Prices break above those highs. It's not supposed to have tails on the top. A PBS after a measured move. I don't know, Footer. I would think probably less likely to work out unless you have a really strong trend day. If you've gotten that size of a move already, and then to get a PBS, I don't know that it fails immediately, but I don't think my feel is, I should say, would be that it doesn't move with the kind of momentum that you think it might, based on the pattern. So this breakout failure here now has formed, right? It's formed a pivot high, which now establishes a new reference point of resistance, or where sellers have stepped up. Once that happens, you look to see if sellers are going to step up again. And we see that they did. Right, we got a potent reversal down. And we got a lot going on this slide here with different concepts that we've talked about today. We have a type of W bottom here. We've got red bar being ignored. Again, a pivot low establishes a reference point of support. What's the reaction to it? Right? Very possible this would have kept dropping, but it didn't. Right? Prices retrace back up. They retrace to the top of this bearish wide range bar, negating it. Right? When supply is strong, right, when bears are in control, right, prices don't retrace back up to the top of a bar like that. Right? So now prices then cleared the high. Right? There's resistance here. I'm taking this away for a second. Right? Look at how this retraced. We just went over an angle of retracement on a prior slide. Look at the angle of retracement. Right? That's bullish. And after this pattern formed, right? Look at the arrows here at the bottom. Right? We're comparing this stock, what this stock did, compared to the futures. Right? Futures are there making lower lows. It's making a higher low. Right? Stock's starting to show relative strength. They consolidated at an area of resistance, so demand continues to pick up. Right? You have to be thinking long. Right? As it takes out the highs and then pushes up, right? We get an initial push higher, right? Up into this resistance area. Yet there's a 200 MA there. Do not be thinking about shorting, right? Patterns like this. It's because there's a moving average there. Right? This moved up strongly. It was showing relative strength. Right? Now the futures are moving. Right? They consolidated. Look at our little bar right there inside near the end of the box. It says it's ready to move up. Right? It's got a void. Right? That consolidation, why did it happen? Right? Why did it stop there? Well, it stopped because it reached a pivotal high. That's a reference point. Right? You and I, other traders, we look at reference points where sellers were before. We look to see if sellers are going to show up again. Then we see what the reaction is, right, to those reference points. Right? This was a bullish reaction to that reference point. Why? Because it tried to go down and it didn't. It couldn't. Buyers kept stepping up. So here you set up your measured move higher in that stock. Futures come up to their 200. Right? You look to the left. It's up near a reference point again. Right? Odds are there's going to be a reaction after a move like this. Right? Take your money. You know this pattern by now. Right? The topping tail, initial move, right? Topping tail bar takes out the high, right? Level 1 pivot high, measured move down. Right? Look at what preceded it. Look at that bar right there. Right? Sellers coming in and taking control. Right? Right? You don't buy, right, patterns like this just because it's a bullish COG and it came down multiple bars. You might think there's a climactic buy setup. Don't do it. Right? Don't do it. See if sellers come in again. Right? Take the next leg. Right? This was the initial move. There's your secondary move. Right? That correction bar sets up a new entry. Patterns, are being learned more and more. Right? Years ago there were fewer traders, excuse me, that understood patterns. Most have a very basic understanding of patterns anyway. But as more begin to learn about them and identify them, they still aren't. Well, they're not going to know them the way I'm explaining to you. Because this is years of study and an understanding about pattern failures and how they work. Patterns, as I said, displaying what other people are thinking and doing. Looking at it from that point of view, right? We can see when others have gotten caught on the wrong side of a move. Right? Why do traders trade against the trend? Because the majority think that prices can't move to the extent that they do. They don't get in at the proper time where the move starts. So because they didn't participate in the move, they start thinking to trade against it because it can't go higher. But whatever the reason is, we can see the pictures, right, of those failed expectations when they happen and how to take advantage of them when they do. Okay? And sometimes, the trades we get in don't work out. So by recognizing that, we cut our losses quick and step aside. All right, let's take a little break. Let's take about 10 minutes. It's 3:31 here. Take about a 10-minute break, and we'll continue with multiple time frames. And if you have any questions, You're welcome to throw them out there if you want to go back and look at something. If you have an example of a pattern, that's something that we've talked about, be happy to review it. Was that the one, Hammerwood? Okay, hang on 1 second here. Most of those, probably most, if not all of those presentations that I've done at those expos are at moneyshow.com. Passed it for a few seconds. You mean at the show? Now, when I'm presenting there, I have no idea what they're showing. Sometimes the camera's on me. Sometimes they're showing the, the overhead slide. That's one of the presentations. That's from one of the presentations that I did at the. No, I don't watch the videos. Just looking if there's any other. Let's see here. Expo. I think this is it. I think this is what you're looking for. There you go. I think you can print it from what I posted. Let me just see something. That if it's not grayed out, and I'm not sure, there's a little printer icon at the top of that that image where you can print. Grayed out. All right. Give me a second. It just, it can capture it. If I just captured it and saved it as a JPEG, anybody that wants it, you can just email me and I'll send it to you. I'm wondering if there you go, print screen. I'm wondering if I do it this way, if it comes up any different. Let's try that. No, that doesn't work. Alright, anyway, you got it. You can print screen or capture it. If you've got the idea, right? I mean, it's good to have pictures to refer back to, but you know, you've got the idea based on, you know, what we've been talking about. Right? Somebody gets caught on the wrong side. You know, primarily we're looking for these kind of things, either climactics or attempts to move against the trend. Some of it is, like in the candle section, there are, not all of them, you know, but some of them, the ideas behind it certainly are. Basically the same thing, just a different, a little bit different setup. Again, the breakdown failure, more like a shakeout, where the breakout bar failure is just a more subtle pattern, that's all. And the breakout bar failure is one that tells you, hey, take your money, this isn't following through. You wouldn't want to take the opposite side of the trade, meaning, you know, if it was a breakout bar failure to the upside, I wouldn't suggest shorting it, you know, because it's still up. What a breakdown, you know, that could be like a shakeout type of a pattern where you could trade against a move. And with multiple time frames, we have to decide what time frames we're going to look at, and the choices are close to being endless. You know, especially when you start getting into, you know, what the platforms can do today with tick charts, volume-based charts, and so on. But we don't want to overwhelm ourselves by looking at too many time frames, and the odds of them all being in alignment at the same time, it usually doesn't happen. Right? Now, so if you're waiting for that, you're not going to be trading too often, and you know, that may lead to confusion. And so we have to decide the time frame that we're going to trade in, and a time frame that we're going to take a longer term bias from, and then apply the various concepts that we've been discussing. Looking at these different time frames, we can look at patterns within a pattern. Right? Some people refer to that as like taking an X-ray or drilling down. We can refine and into shorter time frames when we get a bias from a longer. And sometimes it tells us when a shorter time frame might actually fail, and that's usually when it's, you know, that pattern forms against the direction of the longer time frame. Okay? Looking at smaller time frames, you know, pattern, you know, failures or the beginning of a failure happens in smaller time frames, right? You know, breakout failures begin in smaller time frames. For example, what's happening currently in the market, that breakout above the recent highs and that topping tail that formed, right? There's nothing wrong in the weekly time frame right now. Matter of fact, the weekly time frame, you know, last week was just a narrow range bar. It doesn't say that there's something wrong with the current trend on the weekly time frame. But this pattern that formed at the end of last week might be the beginning of a correction to where it eventually evolves or deteriorates into the weekly time frame. Right? Obviously, we don't know if that's going to happen, but this could be the beginnings of it. Right? We look at when we have multiple time frames in alignment, right? And we have multiple voids. Does this suggest a bigger move? Right? And yet, when you look at different time frames, right, they give us different pictures. Right? We look at patterns, so we're looking for pictures that we understand. There are times where prices get erratic. For example, you're looking at a 5-minute chart. Things are whipping around there, and there's really no setups. It doesn't make any sense because there is no sense to it in that time frame. So maybe you go and look at the 15-minute chart or the 60-minute chart where you're compressing that information, right? Where that now you see a pattern that you have an understanding of what's going on. That being said, you still have to wait for the time frame that you trade in to clean itself up or to present itself in a way that you can place a trade, but that longer time frame has given you a bias or a clearer indication of what's happening. The matrix here on this next slide, it says don't fade the time frame above the one that you trade in. Right? This is a simple rule, and we've been discussing this over the last couple of days, and is that you get your bias from a higher time frame. You look for that lower time frame to be in alignment with that. So if they're in alignment, then it's okay to move down to smaller time frames for either alternate entries, right? Add to positions, right? Possibly manage. An example of this is here we have a daily chart. A sideways consolidation, and we get a bottoming tail bar here that closes on its high. So we say that's our alert day that says we want to buy above the highs. Well, the weekly time frame's in alignment with that. So I can go ahead and trade that, take that trade, right? And I can take alternate entries, right, or new entries from smaller time frames when those patterns are in alignment with the bias from the higher time frames. And so we have a 100% reversal of the prior red bar on the 60, right? On the 15-minute, we've got a shakeout type of a pattern, and so different time frames present different pictures. Right? We look for those pictures in the smaller time frames to be in alignment with the bias from the higher time frame. It is a climactic buy setup with a bottoming tail on the daily. The weekly's in a downtrend. There's no reversal. I'm not buying this. Right? I don't trade climactic patterns. I don't trade against the trend like this. Right? I can take this pattern, right, this daily pattern, right, that suggests that this is going to retrace. I can go and trade it intraday if this sets up a pattern, right, where the trend reverses on a smaller time frame, right, for scalp trades. But I'm not going to trade it in this time frame. Right? Look at the start of the move down here. Right? Just want to reinforce what we've been talking about. Right? Here's the move down. Retracement forms a pivot high. Pivot highs give us reference points where sellers step up, retest, potent reversal, right? M type of a top or a retest of a high. Right? Here's your short setup there on the daily. Climactic setup on the 15. Right? Multiple bars moving up into a gap fill. You're looking for it to retrace. Well, you're not shorting that. Right? You got a 60-minute W bottom. Right? So the higher time frame is in alignment. again, no trade, no sense in going any further. Covered this concept in the gap section. Right? The transition from red bars into green bars, right, happen in smaller time frames. And so when you have a higher time frame that is pointing toward higher prices, right, we can buy pullbacks in smaller time frames where the momentum slows down and begins to reverse. Right? These are going to be at points where we have bearish bars in higher time frames. So when you get a bias from a higher time frame, we don't need to have a changing of the guard or a bottoming tail in that higher time frame to take a trade setup in a smaller time frame. Okay? There's going to be corrective bars or red bars in higher time frames that are pullbacks in smaller time frames. That's something that sometimes confuses traders when they're starting out, is they see a higher time frame and they see a bearish bar and they think they can't take buy setups in a smaller time frame. You can, as long as the higher time frame, right, is bullish. In this case, we're looking at buy setups. Right? You can take those buy setups in smaller time frames, right, when the higher time frame is bullish. And you have, in this example, you have this wide range bar, right, starting to move higher. Right? So you have to have an event, right, that suggests that prices are going to continue to move in the direction, right, of the higher time frame. Right? A better example, of course, would be prices already having moved up, but you have that over here. Right? This bottoming tail bar, right? This bottoming tail bar, right? Is this correction here and the pullback on the 2-minute. We look inside of higher time frames, right? Drill down to see what's happening inside of them. Right? So here on this 5-minute chart, I can see this M formation, which is signaling distribution, whereas on the 15-minute, I've just got overlapping bars. Right? Again, going down to smaller time frames can give us insights into what's happening on a higher time frame. In the support and resistance section, we covered clusters of opens and closes where the opens and closes of several bars overlap each other, and using that as a reference point, it's going to be a base in a smaller time frame. Right? That slowing of momentum on the higher time frame is a base and consolidation in a smaller time frame. That's why we're using those clusters of openings and closes as a reference point. Well, using the 20 and the 200 wouldn't necessarily tell you what was happening in the higher time frame. Right? We discussed yesterday, does a moving average relate to a higher time frame? Right? So we talked about the 20 and the 40, and the 40 MA being the 8-period moving average on a weekly time frame. And so in that case, it does relate to a higher time frame. Okay. Again, using retracement analysis, right, as we talked about, that would give you insights into a higher time frame. Right? Deeper retracements in a smaller time frame. But again, we can look at a higher time frame. Again, this example here, and I can see that prices are moving down on the 5-minute. Right? Right? The 20 MA is sloped downward. And so that this buy setup at support here, right, isn't a quality setup. But I can see on the 15-minute that there's a sell setup at resistance. Right? This high here, this high point, right, was a PSS on the 15-minute. So again, different time frames provide me different pictures, right? And we're looking for, the different time frames in those pictures to be in alignment with each other. Right? So again, just looking at the 5, I see the 20 and the 200 here. Is not a setup for various reasons, right, that I'd be interested in taking. Right? Look at how the move down started. Right? What do you see? How this began its move lower on the 5-minute. Right, exactly. It's a bearish wide range bar. Right? So just like we don't want to take sell setups that begin from bullish wide range bars, right? I don't want to take buy setups either that begin with bearish wide range bars. And doubly, I don't want to take a buy setup where the trend is down. And the confirmation of that downtrend would actually be this reversal here actually failing. Right? These are this is showing a measured move lower. So even though the 20 is above the 200 here on the 5-minute, right, this is still in a downtrend. And look at the 20 MA is sloped down. A 5-minute is in a downtrend, but it's at support. And so I don't want to be shorting anything at support. I want a reaction. I want to see a correction. Right? So my bias is that this is going to go lower. Ideally, the ideal sell setup occurs in an area of resistance, right, where there's supply. Okay. So again, this green bar into the red bar, right, was the PSS on the 2-minute, or that transition from that green into the red. Right? Now, on the 5-minute, right, and because we look for patterns, right, the highest probability patterns, right, ideally this little red bar would have taken out that green bar's high. Okay? That's what I would have wanted. Again, PSS on the 2-minute was right up at resistance here. You had a narrow range bar. It was saying it was going lower. Got 3 time frames working together here. Daily in a downtrend, topping tails. We're looking for lower prices. Look inside the topping tail. It's an end of day base. Okay. Now here's the breakdown in the morning. First 5-minute bar, igniting the move to the downside. Okay. Your prices are reacting back up. Right. Here's the supply. Right. Here's the PSS on the 2-minute. Okay. The 2-minute allows you to catch the top of the move on the topping tail bar. If you don't look at the 2-minute, our method says you're going to have to trade below the bar of that topping tail bar. 5 minute, breaking down, right? Reaction back up, looking at the 2 minute, topping tail bars up in, I say new supply because the prices gap down, this data wasn't here before, right? As it moves sideways there and then moves lower, it becomes a new reference point on that day, or this area has been created. And so once that happens, we've got a new reference point on the day where prices come into it. There should be sellers. We look at the reaction of that, topping tail bars, right? It should move lower. And I got a daily PSS, 60 minute is rolling over, right? Retracements on the 5 minute up to areas of supply are going to be shortable. And so as prices react back up to a prior area where sellers had showed up, right, we look to be a seller up there based on our bias from the higher time frame, and I'm looking for a pattern. Green up, red down. It's a topping tail on a higher time frame. It's a bearish pattern. You short it under the low, right? It should go lower, right? You're going to sit, you see these wiggles here, right? There is support on the 5 minute, but the higher time frames are saying that it's going to move lower. And so you take the short, right? You sit through this, right? See if the trade's going to work out and move it. Once it moves down, right? It starts to move down under here. Right? That's where the momentum picks up. Right? Once it clears this area, right, and the trade starts to work, and you come into the void, that's where prices begin to accelerate. Once you get past that initial congestion. We went over this concept in the retracement section, right? Looking inside of the patterns, here's a climactic. Right? Prices had moved up on the 15 minute, wide range bar up. Right? 2 minute M top. And so again, going down into the smaller time frame, right, I can see that distribution pattern. Right? This creates a pivot high. There's the retest. There's the reversal. Right? Get short. Right? There's a void below. And climactic patterns create voids. That's why we look at them. Right? Why we use that concept. Right? It creates a void. Right? Then look, right, with a turning point, and we can manage it from the smaller time frame that we enter it on. This is a different setup. Now, there was a gap up, right, where you had a sell setup on the daily and an end of day base, and prices gapped up above the top of that end of day base, right? Which now traders that were short overnight, right, get some nervous. This is it coming into some support here. Looking at the intraday pattern. Right, the narrow body tells us momentum slowed. You get a bottoming tail bar. Right, buying it into the gap fill as a short-term trade. Right, looking for a move higher. Right. Based on where this was earlier in the morning, right, if it had closed up there, right, closed up around $46, you can see on the daily that we'd have a failed red bar and a green bar here, which we could put on an interest list for the next day, right, which might result in a continuation of that move higher up into this area, right, where I would say, well, sellers would probably show up, right, somewhere up, right around here. Right? So we could have a continuation move where eventually the price pattern fails up in this area of this prior high, right, if we had gotten a green bar on the daily. And breakout bar failure on the 60 sets up a potential move lower. Prices did break below that bar, and the wide range bar down creates a void up above. The wide range bars like this, starting a move down, suggest that prices are going to continue to move down. This, while it's in an area of support, again, we want to see what the reaction is to that area. Now, as this began to go sideways, and in this time frame, we're still going to be looking for prices to go down. And we're just getting a consolidation at the bottom of the wide range bar. Right? But it never broke below the lows. But drilling down into the smaller time frame, right, we can get insights as to what's going on, because we are looking for patterns. Right? The patterns communicate to us what's happening. Right? This retracement up, right, moving up into that congestion, looking at the angles that this corrected at, the attempt to move down and the wide range bar up. Right? So I can see how demand is picking up here. Right? And of course, once it starts to move up like this, odds are it's going to continue to move up, because wide range bars, as I said, these are multiple bars, right, moving in a smaller time frame, and it creates a void. So what makes these wide range bars dangerous, right, is that if you get short after them and they don't follow through to the downside, right, a lot of times prices will retrace all the way back up because there's nothing to stop them from going higher. Right? And if you get short after a wide range bar, and let's say you got short even, I know this didn't trigger, but let's say you get a 1, 2, 3 that actually triggers and it begins to move up again, right? There is the potential to go all the way back up toward that high because there's nothing to stop it. There's a doji. Dojis say that momentum slowed down. Traders look at these slowing momentum, they're looking to short them, right, if it breaks the low. Here is that doji bar, right, the intraday pattern. Now, if you had a bias to short this, right, in intraday, right, it never set up for you. Right? It never formed a PSS, and it never triggered. Over here, there was a breakout bar failure that set up. It never traded under the breakout bar's low. Right? Even when it retested that bar's high over here, it didn't move lower. Again, the 5-minute chart never confirmed, right, with a confirming pattern to what the daily chart was suggesting. And I said, is it a good short setup? Right, looking at this daily chart, look at what happened at the low. Right? Think about retracements. Look at how it started up off of the low. Right. Look at what happened down there. Right? So, and here's another example: wide range bar to the downside. Look at the volume. The volume exploded, right? Which certainly is suggesting that it's going to go lower based on basic understanding of price and volume. It trades under the lows, and it wound up coming right back up. So we had a breakdown failure, and then as prices begin to move up, I can't see what's inside this bar, but I know a wide range bar is a momentum move. Right? It's multiple bars in a smaller time frame. Prices have retraced almost to the top. Right? Just about right there to the top of that wide range bar. Right? So it was a deep retracement. Right? So while this told me that the momentum slowed down, right? Overall, this pattern on the daily chart wasn't as bearish as what had preceded it. Over here, actually, it was negating that bearish pattern. Here's an example of multiple time frames, right, being in alignment, or the bias is being in alignment. And there was a price void on the daily, right, range contraction, a reversal, looking inside there, right, nice consolidation. Right. So when you get a gap up, which creates a void, right, look at the gap here, right, and this move higher, the inability to go down, right, is bullish. Right. This consolidation right here, once that formed and prices moved up, it then provided a reference point where buyers had stepped up. So as prices pull back into that area, right, we're looking to see what kind of price action forms. Right? Can it hold that area? Because that's where buyers were before. Okay? Then we look at the bars that form. We're going through the same routine, what we've been talking about now for 2 days. Right? Bar by bar. Here's support. Bottoming tail, red bar. No follow through. Turns back up. Bars with tails. Bar that closes at its high, it should go up. Right? Here's a reversal on the 5-minute at that point. Right? 1, 2, 3 continuation. Right? And multiple patterns, voids, right, in alignment with each other. And a review of what we just went over. And the idea is get your bias from a higher time frame, trade it in a shorter time frame, look at those reference points of supply and demand, right? Them to be in alignment with each other. If you got a tradable void, right, odds are you're going to have a successful trade. Combine the failure patterns that we went over with your bias, right, the failure bars, right? And it's all about supply, demand, retracements, bar by bar, right, and voids, right, for setting up our trades. Right. Without money management and rules for managing the position, right, everything else, right, while interesting, odds are you'll lose money. Right? If you are putting on position sizes that are too big, sooner or later you're going to blow up. If you don't have rules for managing the position, you're not going to know how to handle them, right? Which we've gone over. But right? Well, let's review. Right? Going through the thought process of money management. Right? So once you find a pattern, right? It says doesn't mean you're taking a position. Right? Is there room? Is there a tradable void? Has it moved already? That question, right, makes you think about whether you're chasing. Right? So you may have seen the pattern, right, but you didn't enter on it. Right? That's one of the biggest demons, right, and mistakes that I would see happen, years ago. Years ago, I used to trade with students in White Plains in the office up there, and we would review their trades at the end of the day. And one of the most common things was that rather than entering on the PBS on the pullback, right, they would be entering several bars up, and then would stop out for a loss. And they often say, I would say, well, why didn't you buy it on the pullback? And they would say, well, it looked weak at the time, or someone was on the offer. And I was like, well, of course it looked weak. It was pulling back. But the idea is the overall trend and bias is to the upside, and it should go up, so you enter. Right? So you want to make sure that you're not entering late. Right? Where's the stop? Right? Did you look at multiple time frames? What about the broader markets? Right? You considered relative strength and weakness, right, and the market internals. Does it meet your reward to risk parameters at the time? What time of day is it? Right? Even patterns that appear to be good patterns have a higher tendency to fail in the middle of the day or after there's been a move in the morning. Right? So the doldrums are going to be lower odds time of day. And is it a quality pattern? If you've got a problem taking stops, you should read this about 100 times. Right? It's a point that you predetermine the probability of the trade working as originally intended no longer exists. Right? So you get out of the trade. Right? There's no guarantees. Right? We go through concepts that we've gone over here. Right? We look for quality trade setups. If it doesn't work out, right, we exit the trade. We're using technical stops, right, based on the pattern. Right? We don't use dollar stops, right, better than nothing. Right? But using dollar stops, especially if you're entering after a move has begun, you're more likely to incur a loss. Right? And it's accepted before entering the trade, right? You assess your reward to risk. Trailing stops the way we discussed in the trend section, right? Trailing prior bars, lows for longs, right? Once a pivot low forms, we can raise our stop there, and if it continues to move higher, momentum picks up, right? We start trailing prior bars, lows again. Right? You're going to get stopped out, right? Stops happen, right? They save your money, right? You don't want to be experiencing, huge losses. When you review your trades and you review your losers, right, one of the things you want to see is that those losses are relatively close to each other. You don't want to be seeing, big losses and little tiny losses and then big losses, right? You take, calculated risks. Targets. They're only focal points for planning the trade. And then you reevaluate, right? That's as bars form, right? As prices move in one direction or the other, that's new information. It says don't be set on the target. Meaning it can get you in trouble if you think like, it has to get up to my target point to sell. We don't know what's going to happen once we get in the trade. We reevaluate. Okay? And by doing that, right, it may actually keep you in a trade, right? Because while you had thought prices would only move to a certain level, right, there are times where prices are going to move well beyond where we thought they might. Right? So managing it the way we've discussed will keep you in that trade longer. Okay, sure. We can go back and look at it. We could look at some examples. And explanation. Well, here, here's the idea, right? Of with the targets as we go through this setup right here, right? Here's the setup where prices have pulled back. Right? They had pushed up, and they pulled back to support. Now, the retracement here is deep, which makes it questionable. But the breakdown failure, or this shakeout type of pattern here, right, based on this gap up and this consolidation, right, makes this a pattern that we're going to want to focus on. Right? So once we get this green bar, right, we need confirmation that it trades above the high of that bar. Right? When we say it is what it is, right, you've done that analysis. Right? You've determined that you've got a pattern and you've got a trigger point here. Right? You've got a target. Right? You've got to stop. Right? It's time to press the button. as we go through, right, the setup, look, what's our reward to risk? Why are we doing it? Well, I've got a failed pattern. Right? There's a price shock there. Right? Liquidity is good. Check your spread, volatility. What's my entry point? Right? Where's my stop have to be? Right? What's my max loss plus slippage? And so I've got a max loss of 34 cents plus slippage. Right? I've got a gain possibly here of $1 to $2 if it can reach this prior high. I've got a good setup here. And now, based on where your stop has to be, right, we need to calculate share size. This is something that you need to do, right, prior to the trade, right, looking at or being aware of different size stops and how many shares you're going to trade based on that. Well, let's say you've got a $100,000 account. Right? It's just some guidelines. You make adjustments for that. Not saying that you should risk 1% of your capital on any given day. But the idea is to say how much I'm willing to risk on any given day, whereas if I lose that amount of money, I'm going to stop trading. You can paper trade, right? But you have to have the discipline to stop because it's about capital preservation. Right? So now you decide how much that might be. You then say, well, how many trades do I want to break that up into? Right? You can say it's 3 trades or 2 trades, whatever you want. Right? So here we're saying 4 trades per day. Right? So my max loss per trade is $250. I calculate my share size. Right? So 40 cents based on the prior setup that we were looking at, which says 625 shares, which includes slippage. And so back to our setup. So it gapped up. Right? It didn't just trade above that bar's high, giving us the entry. It had gapped higher. So now I have to figure out how I'm going to get in to this. That's why it says it could be a 5-minute high or a 30-minute high. Maybe it would have pulled back into the gap fill. Right? It would have given me an entry point. So it was a pro gap up. So I want to put my stop. This is put your stop under that bar for at least half of the lot. Once it moves up from here, it shouldn't go back down under there. Obviously, if it takes out this area, you're just out. Okay. So now we have to reduce the share size, right, based on a higher entry point, because then we want to get back to this $250 risk. Okay. So now we've got a 51 cents to that low. We had 2 cents for slippage. And we're down to 470 shares, and you can round it out, right, and just say 500 shares. And now as it's moving up, you start trailing. You start trailing prior bar's lows. Right? If it takes out one, right, you'll sell half of the position. And it says you're now managing that position, right? Which is managing money. But the idea is here that you're not thinking about the money. Or you shouldn't be thinking about the money, right? You're managing, right? You're following your trading plan at this point. And as prices push up into this area here, this pivot high, right, tells me that there's going to be sellers up there. Right? So your target area, you can just offer out at that point up into that area, right, looking to get taken out on the offer as it pushes up. You can just obviously hit the bid, and if it's got momentum, you should be able to offer out into that demand. And so it's hit your target, wide range bar. Right? Momentum increases after multiple bars higher, odds are it's going to consolidate. Right? So it says time to reduce or get out. Right? The wide range bar tells you that the majorities are now getting in. If the daily is at the high, so you're saying like a 52-week high, there's no resistance there. You can use the sector as a guide. Maybe the sector has congestion to the left, whereas that stock was showing relative weakness and it was stronger than the sector. You can use the market as a guide. As the market comes up to resistance, you can use market internals, right? For example, prices are moving up and the volatility index is moving down and coming down to the area of a prior low, right? So the VIX coming down to support would suggest coming weakness in the market. Pivot moves, meaning average moves, yeah. If the prior move, it's kind of like a pivot move in a sense is another way of saying a measured move, which we discussed. And trailing a prior bar's low. I mean, you have a stock that's making new highs and moving up. I mean, if it doesn't form a wide range bar where it's become kind of a climactic type of price action, right? If it trades under a prior day's low, that'll get you out. Those are some of the ways that you could handle that. If you focus on the money, right, it typically leads to failure. Right? You're thinking about money, right? Odds are it's going to lead you to doing the wrong things. Right? So you plan your trade. Right? You know what your max loss is per trade. Right? You've accepted that. Right? As a professional trader, you've accepted the possibility of whatever that loss might be. Right? It's based on your account equity. You know it's not going to put you out of business. It's one trade. You can't accept that loss. You decrease the share size. Right? If it doesn't make sense to trade that small, right, well, you don't trade. Right? It's as simple as that. You got to focus on the entry, the chart, what's happening in the market. Right? Now, emotion, you're never going to remove all the emotion, right? But if you have a plan, right, if you have a method and you have a trading plan that you're going to follow, and you have the discipline to follow it, right, it's easier to make decisions, and it reduces the emotion from what we're doing. Right? When we feel anxiety and tension, it's usually because we are, avoiding something. Right? And we don't want to let the P&L, right, twist our thinking. This is an important point. It's not your money until you exit the trade. Don't count money until it's out. You're done. Right? You're thinking about the money while in a trade. Right? You're focusing on, what's important. Right? The market environment and what you're seeing on the chart. The question is, why are you doing it? Right? Scared money. Right? And say thoughts. What if this happens? What if my stop gets hit? What if it doesn't hit my target? Right? Don't bother asking that question. Right? You don't know the answer. Lack of confidence, right? Based on a lack of knowledge. Right? You're not going to trust that you're going to do the right thing this time, entering or exiting. Right? Trading too large of a position will definitely make you think about the money. Best thing to do, as we've discussed, slide 1, right? Focus on the plan, right? Trade small size, right? Get the experience, right? And eventually, you start building up. And even if you can trade X amount of shares, it doesn't mean you have to when you're starting out. Why take the risk when you're looking to gain experience? It's not about the money. Damage control. You're human, right? You might ignore a stop. It is possible. Right? Overnight position. Gaps against you, right? That might happen. Your system goes down, right? Well, don't panic. Secondly, you should have a plan for these type of things. If your system goes down, one of one of the things that I believe everyone should have is a backup internet connection. Right? Why not? They're cheap. Right? The technology to manage those two connections. Right? They're, and if you're not aware of these things, some of you are, tech savvy, but some of you that aren't, there are routers where you can plug in both of those internet connections, and it balances, those two connections, and it'll flip from one to the other automatically. Right? This isn't high tech anymore. Right? It's pretty commonplace, and it's inexpensive, and you should have it. Right? You should have your broker's phone number and a speed dial. Right? You should have it in your cell phone. Right? You're prepared. You know what you're going to do. Right? When these type of situations happen. Right? You assess situations as if it's in someone else's trade. It may help you think more clearly. Right? See if there's a better place to get out of it. Right? You close out the trade. Right? Put it in your trading journal. Study it. Make notes. See what happens. Right? Avoid repeating errors again. Right? Contact the coach. Right? There's coaching every week. If Simon isn't doing coaching, there's coaching at 12 o'clock. Right? On various Tuesdays, there's TPM1 coaching, there's TPM2 coaching that Ron does. Right? Those are valuable sessions to come in and review what you learned in the class, discuss trades that you've done, say, am I looking at this properly? What did I do wrong? Right? What did I do right? And so on. Getting back on the horse. Right? You've gone through a losing streak. You keep, having losers. Well, why do you keep trading? Stop. Right? Stop trading. Take a step back, from it. The market will be here. This is what gets traders into, revenge trading. I got to make my money back. It becomes a vicious cycle. Right? So you got to get some distance, right, from that negative energy, so to speak. Right? Review your trades. Right? Look at the winners. Look at the losers. You're going to recognize patterns. I guarantee it. You're going to see patterns in the ones that worked and the ones that didn't work. Right? Eliminate the poor quality trades. Right? Get in a positive state of mind. Right? That's something that we've discussed in the room at prior times. I don't remember. I've had a few different moderators at the time. I don't remember who it might have been anymore. But yeah, that isn't going to be possible anymore now that YM is trading on the CME. I remember the YM used to trade on the CBOT. Now everything's trading on the CME. But so what would you do at that point? Yeah, I remember it. You can offset it by trading spiders, right, or diamonds, or Qs. And review your demons at the beginning of the trading day. Right? Start paper trading, right? But do it as if it was real money. Right? Develop consistency. Small share size. Right? Start building confidence. By reviewing those. 3-to-1 winners. Always be selective. And then review what's in this manual and study it. Right? And it says the answers are going to be here. Here's a key point. If you have two scenarios, right, no matter how bullish or bearish the setup is, it keeps your mind open to other possibilities. Right? We know anything can happen. Right? There's no guarantees, so you may as well consider it. Right? Even something opposite the chart. Right? Overcome these temptations. right, of entering trades before you have a setup, right? Because you're afraid of missing out, right? That's what impulse trades are, right? You're getting into trades, but they're not part of your trading plan. That's what an impulse trade is. Right? You have to overcome the temptation of selling because you're afraid that prices are going to move against you. Right? The bar-by-bar analysis will help you tremendously with that, and of course, understanding the concept of price voids, right, and the potential of where prices can move to, and then incorporating market internals. Okay? The patience and discipline, right, we know that's the hard part. Right? That's the human part. The technical part, understanding it, that's the easy part. Right? It's overcoming the human part that makes trading hard. And so you can do it. You've got a method at this point. It's clear. It's objective. You just now have to work with it over time to gain confidence in it and have it become second nature, right, to what you do on a day-to-day basis. Trading day prep. Trading day prep, right, for the next day begins at the current day's market close. Right? We monitor news that's coming out, see how that's affecting the market, right? Other stocks, right? Is it presenting other new opportunities? You review your trades. You complete your trading diary. Okay? Update your watch list for the next trading day. Do your analysis of the broader markets. Right? Has the trend changed? Was there a breakout failure? Was there a breakout of it of itself? Right? What are the market internals telling you? Go through the various sectors. Right? Set alerts. Right? This has a key levels. Right? Exercise. Right? You got to take care of yourself. Right? Because sitting in a chair all day, right, isn't healthy. Right? So we got to take a break. Right? Get away from the computers. This is an addictive business. Most people that are doing this, virtually everybody I've ever met, especially if you've gotten to the point where you're taking this seminar, you're passionate about doing this, right? You enjoy it. You want to learn more and more, right? So you can lose track of time and everything that's going on around you, right? So you got to, step back from this, and take care of yourself and enjoy, take a little time, to enjoy yourself. And I'm one of the worst offenders of that. We're definitely, less so at this time. But when I started out, doing this, especially before I started doing it and gave up my other business, there was no life other than running that business and studying about the markets. Right? It was work all day, study until, charts or read books until I was exhausted, and then start the whole process all over again. And during that process, I didn't take care of my health, started putting on weight, backaches, and so on, and then, eventually, you start like, what, you got to take care of yourself, right? I started, it was about the end of 1989, Dr. Java, and that was from a point of, I didn't know anything about the market at all. Now you want to know how old I am? Yeah. When I started, I guess I was in my 30s. Okay. I'll be 54 this November. So I didn't start out, learning about the markets, when I was young. Well, no, you know what, P. Horner? you have a tremendous advantage over me. You know, I'm sharing this information with you that I've studied for years. Right? Remember, this type of information, virtually very little information was available. You know, going back that long ago. Right? You know, there was like Edwards and McGee on technical analysis. You know, we're talking back when, you know, computers ran on DOS, and you had to know DOS commands, right, to transfer data. Right? Things have come a long, long way. And what I'm sharing with you in this class will accelerate your level of knowledge and understanding, you know, far beyond anything that I understood when I started out. Don't worry about it. In the front of this manual, I don't know the picture that's on the front of the manual, Hammerwood. But don't worry about convincing them, because they're never going to believe you, Dr. Jala. You just show them, all right? All right, it's going to take some time. You know, people that aren't passionate about the market, they can't understand it. You know, they think that this is all about gambling, and so you're never going to convince them. Just accept the fact that, you know, of how, you know, what they're thinking, and, you know, hopefully they support you, and, you know, don't forget about them. Right? I would say that's probably the biggest thing. You know, just be cognizant that they're there, and, you know, share your time with them. Whereas, you know, you get away from the screen and go do something with them, and they'll be more understanding of what you want to do. It's when they become resentful of what you're doing, right, that they start to become more angry about it, and, you know, it is. It's not easy. It's not easy. You know, again, if you start out slow, right, trading small, you know, and, you know, it's not about the money. They need to understand that, you know, what you're doing. And, you know, they also need to understand that you're not a threat to their security, right? You know, there are people that start out doing this with no knowledge, or they get some knowledge, and they're dangerous, you know, so, you know, your spouse might be afraid that, you know, of what you're doing. So you have to share with them what's going on, and make them understand that, hey, I'm going slow, right? You know, whatever I lose or I make, it's really insignificant because I'm going through this learning process. And, well, you have people that, you know, go to college and spend $100 grand, and you know, they don't come out of it, and they don't make easy money. Right? Some of them are failures, matter of fact. $5,000 for this type of education. As long as she doesn't break your computer. All right, let's continue. You have to set up your software so that it helps you do your analysis, right, more easily and quickly. Right? So a sector page where you can bring up multiple sectors at the same time, and do your analysis of trends, support, resistance, and patterns. Okay. That's that's called coaching sessions. You come in to support. You can talk to Ron. About these things too. I mean, that would be helpful, I'm sure, for everyone. I mean, we all go through the same thing. Search for new plays. Right? Look through ESP. Right? Look at the end of day scans. Review your universe. You don't have to look at 3,000 stocks. As a matter of fact, if you narrowed it down to price ranges between 10 and maybe $75 and said that you need at least $750,000 shares or 1 million shares, you probably automatically, just with that criteria, probably knock it down to about 600 or 700. Right? Look at your stocks and sectors of interest, and you divide up your long and short ideas. Right? Check earnings dates on those stocks you're focused on, as well as those stocks that can move the market. Economic reports. Right? Look at economy. See what's coming out pre-market, what's coming out at 10 o'clock, what might be coming out in the afternoon, like Fed announcements. Look for the setups we've been talking about. Right? Obviously, buy setups, sell setups, gaps. Scan for volume. Right? You never know what you're going to find. Right? All the various patterns. Right? And then you go and cherry pick them. Right? The quality patterns, relative strength, strong sectors, and so on. Pre-market. Right? Check the news. Right? You've got different sites that you can get information from. Briefing, Yahoo. Right? Heat maps can generate ideas at the NASDAQ site. See where the markets are trading, right, prior to the open. If you're looking at the futures, right, look at those overnight highs and lows. Right? See what the trend is. Right? As we look at that every morning in the chat room. Right? Sort your minder. Right? See what's gapping up and down. Right? Check gaps on open trades if you have any. And you're going to develop your bias, right, for the market open. Pre-market trading, stocks that are in your watch list, right, to see how they're trading. Right? Set your alarms. Right? Don't set too many alarms, right, because it becomes real annoying when you start having alerts that are going off like crazy, and you can't look at all of these different things. Right? Setups from the day before. Right? Look at how they're trading. Maybe you'll want to get in before the market opens, depending on how prices are moving and the setup. Pre-market futures. Right? Markets are trading before the open. Right? Those pre-market highs and lows will come into play. Right? As prices push up into those areas of those highs, right, they're going to have an effect on the market. Right? If you don't have the futures, don't get too hung up on this. Right? If you don't have futures, just watch the spiders and the cues, and look at the gap fill and support and resistance, and and how that's going to affect the market. And if you're looking at futures, right, and how they're trading prior to the open, those support areas come into play. So here, this pullback on this, what's called a 24-hour chart, you see this bottoming tail bar. Well, on the day chart, right, which is 9:30 to 4 o'clock, right, this bottoming tail bar appears to have formed in the middle of nowhere. Right, but we can see that it formed in a little area of congestion there that had happened prior to the open. And heat maps, honestly, I haven't looked at these in a long time, but these heat maps that are at the NASDAQ site maybe generate some ideas for you prior to the open. Let's see if I can find something here that someone had shared in a prior class on heat maps that was really pretty neat. Let's see if I can find it. I think that was it. I think that was it, MFA. I can just click on it, right, and see if that was it. And I'm trying to find it myself. Yeah, that's it. That's it. Good site. Well, that slide that I'm showing you, if you go to the NASDAQ site and find this pre-market heat map, it's sorting the NASDAQ 100. At the open, look at the size of the gap, right? Is it gapping up into support? Actually, down to support. Is it gapping up into resistance, right? Mark that gap area for future reference, right? It may or may not get filled on that day. Look at the first 5-minute bar, right? Does it close above its open? Does it close below its open, right? Tick and trend after 9:35. If you're looking at the trend on a 5-minute chart, in your time settings, right, have it set up so it starts collecting data at 9:35 versus at 9:30. Right? You always get that skewed bar at the open. Right? If you're looking at it on a 2-minute chart, start collecting the data at 9:32 to avoid that bar. Right? With the ticks, you can start them, right at the open. And you want to let the ticks update for a couple of minutes after the market closes. I don't know why, but it continues to update. So to get the closing tick, right? You're looking at a 5-minute chart. Let it go until 5 minutes after 4. Right? Consider your entry points based on what we've talked about. Don't take trades from 2-minute charts, right? Unless you got your bias from a higher time frame. Right? Sort your minder. Right? Net change from open. Right? You want to set up your minder, change from yesterday's close and change from today's open. Right? So you've got those 2 columns, right? And what is trading above yesterday's close and above today's open, right? 2 green columns, right? Those are going to be your strong stocks, right? The ones that 2 red columns obviously are your weak ones. Narrow down the focus list into a separate minder, right? So you might have 50 stocks in a minder. Maybe you've got 100, right? Again, get the list narrowed down, right? Stop scanning, right? Stop looking. Have a few charts, right, that you have those stocks of interest in, right, and focus. Right? It is value your list, right? Be prepared to act on it. News should be in alignment with patterns. Okay? Upgrades after multiple days moving higher are often opportunities to trade against those upgrades on the day. Right? It is profit taking on the news. Whereas, if you've got pullback patterns, right, you got upgrades, right, odds are you're going to get a continuation, right, based on that. News draws traders' attention to a stock, right, or a sector, right, which brings liquidity and opportunity. On the weekend, review your longer-term charts. All right? Look at your universe from a longer-term perspective. All right? Look at your market internals if you haven't done so. All right? Take a look at your sentiment internals. All right? You can look for trading ideas from other trading journals. All right? Barron's gets a lot of attention on the weekend. That might generate some ideas. Of course, update your trading diary with your trades of the week if you haven't done that. Right? Look and see what you're doing right, what you're doing wrong. Okay? It says do your homework. That's what's going to ensure faster development. As we've discussed, right? Step back, right? Relax, spend some time with the family, get some exercise. Right? And take a look again at the broader markets from a longer term perspective. What's happening? Right? Because we get too caught up in the day-to-day. Right? So take a longer term view of what's going on. And I say this at the beginning of the class, I say it near the end of the class. Right? Take the time to study what you're learning. Right? The market's going to be here. Don't risk a lot of money. Right? No point in doing it. Right? You want to develop confidence in what you've learned. Right? Make it second nature. It's going to take some time. That's why we do coaching every week. Right? Email support. Free workshops. It's about hearing the concepts over and over again. In reality, they're not that complicated. Right? It's just about training your mind, right, to follow the rules. Right? There's no such thing as holy grails. Right? No software is going to make you money unless it's supportive of your method that you believe in, right, and you follow the rules. Okay? You don't spend time doing your own work, right, you're not going to make it. Right? Labs, right? The advanced lab, right, incorporates TPM1 and TPM2. It reinforces what we've discussed on a real-time basis. Coaching. If you're not in coaching every single week, right, you are not doing what you need to do to learn this. Right? It's part of the program, and there's no reason not to be there. Right, if you have the time, okay. Oh well, with Simon in the middle of the day, I believe it's about an hour. Ron, you will usually spend a couple of hours. Ron is the Energizer Bunny chatterbox. Right? How many sessions? Well, it's every week, right? So. I don't know, as far as, related to the class, but, I believe it's usually, 2-3 months at least. Do you guys want to take 5 minutes before we do this review? Okay. Let's take a few minutes. We have Ron traveling too much. He has to miss class. Yeah. Ron does a lot. All right, let's take a few minutes. All right, home stretch. Little review. Right, this first slide, right, it's an excellent review slide, right, for a checklist, right, for having a long bias, right, always quality patterns, right, the direction of the market, right, the sectors, right, the stock within that sector, right, what's its trend on the 60-minute chart, right, so you're looking for longs if it's above its 20, unless it's a climactic buy setup. You're looking for entry points on the 5. Right? Is there a void, right, or a loose overhead supply? Right? Tick oscillating above the 0 line, right? And of course, we want to see some tick extremes. I want to see that tick get above 600. Right? Trend, right? Trend being bullish, right? Sideways below 5, right? Below 1 and declining, right? In other words, under its 20 MA. Declining, right, or high and declining under its 20 MA. Right. Favorable time of day, right? Morning, later in the day, right? Be aware of reversal times, right? 10 o'clock, 10:30. Doldrums are okay if the morning's been quiet. Right? Make sure of news that might be coming out. Right? Is the stock showing relative strength? Right? There's your checklist, for longs, for shorts, we just reverse it. Right. This next slide, we looked at this chart on the left when we reviewed the bar-by-bar analysis in that section. You can go back, you'll see this chart, and we had discussed the consolidation, we had discussed this sideways move absorbing the supply over here to the left, and the bullish reversal here, and how this was a nice breakout setup, but it resulted in a topping tail bar, right, which gave us an early warning that something might be wrong. And then we got the inside bar, and the break of that inside bar, we had a breakout failure there. Right? So based on the pattern, right, we had really no reason to not take this trade. But looking at the volatility index at the time, we see that the volatility index was retesting a prior low, or it's making a double bottom there. We're getting bottoming tail, right, in the VIX. Right? Remember, the VIX is an inverse market internal gauge. When the VIX forms a bullish pattern, it's bearish for the market. And so here this was November 9th of 2002. This had formed this double bottom, right? Bottoming tail bar, topping tail bar in the stock. And so the VIX was giving us a warning, right? The market might be near, right, a pullback time. Right? So at the time, right, back in 2002, the VIX, this was a low level for the VIX, which was a warning. Right? Again, the pattern was the double bottom. Right? It was suggesting that it was going to move up, right, at that time. Right? And the sideways consolidation, right, after a move up, a strong move up and a sideways consolidation, that suggests that it's going to go higher. And so it consolidated at this pivot high. Right? We interpret patterns in the volatility index the same way we would a stock. Right? Just it's inverse. So a pivot high is a reference point where there's going to be sellers. Right? A consolidation at a reference point of resistance, right, suggests strength. Right? In this case, that the VIX is going to go higher, which is bearish for the market. Okay. You began to question that immediately. Right? Pattern was the breakout bar failure. Right? Here's your second shock, was the gap down. Reviewing the trading day, okay. We look at the trend. It tells us the volume associated with advancers versus decliners. Okay. If it's rising above its 20-period moving average, we view that as bearish. If it's rising and above 1, that's even more bearish. Right? We talk about 1.5 to 2 being a high level historically, but that doesn't mean the market has to bottom. Right? We want to see that it begins to roll over and gets under its 20 MA and then starts turning down. It tells us that the market is becoming less bearish, right? Or it's improving. Right? So with the trend rising, ticks below 0, right? Futures declining below their 20 MA, right? We have a short bias. Right? We're looking for shorts. We're looking for green bars to be ignored or no follow through to them. Right? Topping tail bar over here. Right? Just a plain old vanilla PSS in a downtrend. Right? With a little bit of minor resistance over there to the left. Right? What's interesting about this setup and what was happening at the time, and this is why we need to review these concepts day to day. What was interesting was that how high the trend was and the lack of ticks that were going to extremes, which is unusual. So this does tell us that we can get these kind of moves down without ticks going down as low as we would like. But the majority of the tick bars were below 0, and the trend was rising, and it continued to go higher, well above 1. Futures were down, so our bias is to be looking for shorts. Right? The volatility index, right? It moves inverse with the market. Right? That's its normal movement, to move opposite the market, to have at times actually a mirror image, right? But a move to support in the volatility index is bearish for the market. And so as we look at the VIX, which is for the New York, right? VIX coming down to support, right? It gives us a bearish bias on the market on a short-term basis. Right? You see the S&P was in a downtrend. It rallied up. Potentially, we got a breakout failure here. Right? The NASDAQ, right, had moved down. If we were looking at a stock, and I see multiple red bars moving down and taking out a prior low and a wide range bar closing at its high, I'm going to put that on my list for the next day, right, for potential move up or at least stabilization. Right? That being the case, right, that's going to put pressure on the market. So looking at the NASDAQ composite, right, it's in a downtrend, got a PSS, right, a little changing of the guard there. The VIX supports a bearish bias. Right? Nothing wrong with being short overnight with a pattern like this, with the volatility index confirming. Right? And you're definitely going to have a lot of shorts on your list, right, with a pattern like this. And again, the VXN, right, is the volatility index for the NASDAQ. If you're using Realtick, it's $VXN.X. Right. This fall creates a void. Rapid price movement creates a price void. We have a divergence at the low. Remember, we discussed yesterday reading momentum and using the moving average, right, as a quick guide for reading, right, this kind of momentum. Right? Divergences are nothing more than slowing momentum. Right? So it made a lower low. It just moved down at a slower pace at the time. That does not mean the trend is going to reverse. Right? It just means that it's going slower. Right? It's moving down at a slower pace. The only thing that reverses a trend is an actual trend reversal. Right? Volume increases on a breakdown right here. Prices break to the downside. Volume increases. There's no follow through. This low that forms down here, after the retracement. It establishes a new reference point, right, that tells us that buyers stepped up. When prices retrace to that area, right, the question is, do they step up again? Then we look for confirmation. Right? I don't have that confirmation until over here. Right? So these were bearish bars, right? And it finally traded above those highs. Right? But we're anticipating that this is where they would step up again. Right? There's a little breakdown failure, right here. Relative weakness, right? Ticks were moving up, the stock was moving down. Right? Relative strength, right? The ticks moved down. We use prior lows in the tick as a reference point for broad market support. Prior highs in the tick are used as a reference point of broad market resistance. Okay? As the ticks had moved down this day, this stock went sideways. So it showed relative strength. Look at where all the candle bodies are in relation to this wide range bar. And so this correction here, it was in the confines of that upper 50% of the bar's range. There's our signal bar. Right? It closes at its high, right? And it was preceded by an attempt to move down that failed. Right? Combined with the concept of relative strength, right? The wide range bar, the consolidation, the tradable void, right? It's a good odds play. Right? Didn't pivot. In other words, if it didn't pivot, that means it didn't pull back. Right? Again, it tells you that demand is strong. I've said multiple times, the strongest stocks don't pull back. Right? They create support. They show relative strength. Right? When the market corrects or the internals correct, right, they go sideways. Right? They form breakdown failures. Right? And then as those other forms of correction occur, they then continue to move higher. In an uptrend, we look for bearish bars to be ignored. Right? Those bearish bars, right, are moves down, right, where buyers should step up, right, and the fact that they don't follow through is confirmation of that trend. Here's our breakout bar failure, and when we discuss those, and I said that these are not reasons to sell short. Right? Breakout bar failures tell you to take profits. Right? That pattern, right, is going to provide a reference point where sellers should show up again. Right? A lot of times breakout bar failures turn into M tops. Right? Again, that breakout bar failure, once it forms a pivot, it takes out the low of the breakout bar. It's going to provide a new reference point for sellers to show up again. Right? And while they did, right, they didn't continue to move it down. Shakeout. Right? Sideways, move up, back down again, sideways. Right? So while it came down to this support, it could not move up. Right? It's bearish. It suggests that it's going to continue to move down. There was a void. Right? Price movement and time increase voids. Right? That's what voids are about. Right? Price movement, right? And then over time, right, sideways movement over time moves current prices away from prior reference points that would be used, right, as technical points where buyers would show up. Right? When we are close to prior reference points, they are most relevant. As we move away from them, right, they become less powerful as reference points and increase the potential to move through them. When we see an extended decline and we start looking for signs of a bottoming process, right, we see that attempts to move lower don't follow through. Right? We'll often see large red bars, sell-offs that pop right back up again. We see bottoming tail bars form. Right? And we see complete retracements of red bars like that. We see volume, right, coming in on the reversals, what we call committed volume. Right? We see shakeout patterns. Right? Shakeout patterns here we see the 15-minute chart is a move down, which might look like a bottoming tail on a higher time frame. Right? Time corrections at supply. Right? Areas of resistance, right, which is an area of supply, right, by definition. Right? The attempts to move lower, where sellers are coming in, don't follow through. Right? We see red bars ignored. I mean, they turn back up again. Right? We see bottoming tail bars form. We discussed this red bar followed by a potent green bar. That's a bottoming tail in a higher time frame. Right? This bottoming tail is this in a lower time frame. And so this consolidation at resistance tells you that demand is strong, right, and buyers continue to step up to the plate. Right? And so these are clues that stock is bottoming. There's a review of M&W patterns. Right? You want to see that there's a price void. Right? The retracements, right, from the first low, right, are shallow. Right? We discussed they're usually less than 40%. Right? You get a retest. Right? It may have a new low. Right? Look for potent reversals on one side or the other. We look for breakout failures. Here, breakout and a failure, right? Or sometimes breakdown failures. We look for pivot lows to form that have established support, or pivot highs to form that establish resistance, that then get retested, and we see confirmation, in this case that sellers step up again, over here where buyers step up. Right. Number one, we have an end-of-day base. Prices were consolidating. Number two, a wide range bar igniting a move down. Got a break under that support. Right? The wide range bar is a multiple bar move at a smaller time frame. It creates a price void. Right? We don't want to see prices retrace back up to the top of that bar. Right? If they retrace, we want to see the retracement stay under the halfway point. Right? So number three is a PSS. Right? Number four are converging moving averages. Right? As I discussed yesterday, moving averages are just visual aids that help us speed up the analysis. In reality, we don't even need them. Right? But they're useful tools, right, to help speed up the analysis process. Right? The 20 MA was declining. You had a flat 200. Right? There was a inflection point here where they were converging. The 20 MA was pointing down. Right? Number five was a wide range bar. Suggests the end of the move. And as prices were moving down, the range begins to expand. Right? There's a little hope here where it stalls. And then you get this is a climactic bar. And suggests that prices are now going to, the momentum's going to stall. Right? Little bodied bar here tells us momentum is stalling. There, COG is a topping tail, right here, right where the star is. And big green bar up, big red bar down, It's a topping tail. Right? Deep retracement, potent COG. Deep retracement. Right? Potent reversal on the 15. Right? Bottom of the 15-minute chart. A reversal pattern on the 5. That's the transition. Is the 5 potent at the low? Absolutely. First reversal period, right at 10 o'clock. Potent bearish bar ignored. Right? That happens right here, right, in the area of the prior high. Right? And this comes after a deep retracement. So bearish bars, after 100% retracement, we needed less weight to. Minor pivot on the 15, right there. That little correction bar. Okay. Then is a little consolidation, which is that clustering of opens and closes right over here. That's the consolidation on the 5. And it is your measured move. Right? Deep retracement. And again, measured moves don't mean that prices are going to collapse. But this move here does create a void, and this sideways consolidation after that is bullish because it refuses to go down. Slowing momentum. Rounding top means it had to have made a higher high bar, and then prices retraced back in again after making that new high. Topping tail. We've got a topping tail right up at the high there. Prices broke out above a consolidation and formed a topping tail, bearish pattern. Right? Current market, right? Daily chart. Look at the Dow. We looked at that earlier. Consolidation, broke out, topping tail. It's going to be interesting to see what happens tomorrow. Does it follow through? Does it break Friday's low? Do we break Thursday's low? Right. Break of 2 prior pivots. There was a strong move down. Right. Bullish bars. Changing of the guard ignored. Right there. Had a little buy setup that failed. Right. Moving average divergence right at the high. Right. Changing of the guard with our 20 MA right here. Sharp move down creates a price void. Right. Get climactic volume at the low. And we looked at lots of wide range bars. And so here was a wide range bar starting a move higher. And it came out of a consolidation. So we interpret that as igniting a move to the upside. Prices retrace back down to the bottom of it. Right? That's bearish. That's not what happens when demand is strong. And so while we've seen this concept work many times, right? Sometimes it doesn't. If it doesn't, we recognize that, right? Move on. End of day decline, and that reversal was the indication of the morning direction. Right? Many times, intraday patterns follow through the next day, even though the day ends and it begins, the next morning. A lot of times these patterns follow through the next day. Right? Gap fill down here. Right? The 5-minute was a little COG down there. Right? And the 20 MA, well, there's nothing there. Right? Remember, moving averages are lines that we choose to put on our charts. We choose which ones to look at, which makes them subjective, and to use them as actual or real reference points of support and resistance can be very misleading and subjective. This slide is what we looked at yesterday morning. right? And I asked you, tell me what you see on the chart. Right? At this point, hopefully you're seeing a lot more than what you did, right, yesterday morning at 9:30. This is what you need to start doing if you're not doing it. Right? Start printing out charts like this and start marking down all of these concepts that we've been talking about, right? And do it over and over and over again. And again, that's the practice that you need to do to reinforce what you've learned and to see these things in real time, because that's the challenge. For you to be thinking like this on a real-time basis in the moment to take advantage of what's going on and putting that all together. And I said, you need to take it slow. Right? Give yourself the time to do it, right? Because anybody can do this. Right? It's, understanding these concepts, in reality, it's not that hard. It's like learning anything else that's new. It just takes a little bit of time. And you just have to give yourself that time. And if you do that, right, you can do this and you can be successful at doing it. Right? But if you rush it, right, and focus on the money, right, it's just going to take longer. Right? And we all do that. Right? We all get involved in doing this because we want to make more money, right? And we all, right? And I was as guilty as anyone else in making this taking longer than it has to because of focusing on the money. Right? So, learn from my experience, and the others, that are part of Pristine and their experiences, right? You can shorten your learning curve by doing that and listening to us, right? Hopefully, you do that, because we've all traveled the same path that you have, right? Take it slow, right? Follow the rules, right? And you can do this. I assure you, you can. Right? Any questions, guys? Any slides you want me to go back over and review? Happy to do it. If you want to take a look at some charts, right, examples, happy to do it. Sure. The idea is that you formulate a plan, right? So to say that I think that this stock can go up to this area, and again, once we get into the trade, obviously we want that to happen. So when I say don't get stuck on it, don't get set on that target, means don't rationalize information that says it's not getting there. And if you get a potent reversal down, you get a breakout failure, accept it, and don't avoid that information. And that's the point there. Level 4 is defined by higher high, higher low bars. Right? You got it right. Just 2 consecutive higher low bars on either side. That will do, but we define that as a level 2 pivot. Remember, when we started that pivot section, right, I started out by saying, right, something with 2 higher low bars, however they formed, right, we're going to use that as a reference point, right, as a pivot low. Okay? All right, everyone, have a terrific night. I'll talk to you, those of you that are in the chat room in the morning. All right? I'll talk to you in the morning. I wish I could tell her. All right? Have a great night, everyone.
Vou olhar agora. J-R, o quê? Manager. Ela é gerente. Gerente.